My bull case has a stock going to $2,000 over the next few years. $2,000. Profitability is literally going down for them now at this point in time. What an insane move. I feel bad for people that believe this. This is a big buy for me. It frustrates me how many people don't understand meta. People are going to start thinking about, like, are these companies going to spend as aggressively in future years? This stock's about to be on a rocket ship ride. It's the most attractive super small cap stock I know of. These are serious things that I don't think a lot of people are taking serious enough right now. Then you could have a situation where no one wants a piece of any tech stocks. A company with multiple brands that has multiple growth levers to grow these brands, get more shelf space, go up on price a little bit as the years tick on. What stock did I spend $71,000 on here today? Busy times, huge moves all over this market. Boy, do we have some things to speak about here today. Honest stock up about 40%. What an insane move. Elf climbed onto the shelf even a little bit higher here today, ladies and gentlemen, up about 7% or so. We're going to talk about Elf in this video. We're going to talk about some other movers in regards to this. Celsius, we're definitely going to get to in this video here today. We'll talk in depth about Celsius, what I'm up to there, my opinions, perspectives there. We'll talk about what stock I put $71,000 into here today. So got a lot of that sort of stuff to speak about in this one here today. Then I want to react to a few videos here. This one from 2 hours ago, debating the road for the S&P 500 to 8,000. I want to listen to what the Wall Streeters have to say and then share my opinions and perspectives there. AMD. We're going to listen to Stacy Rascon, a gentleman that in the past has come across as a big AMD hater. I want to hear his opinion on these latest AMD numbers and his opinion on AMD in general, right? And then I want to go ahead and react to this one. I think some very important things were said here for anybody that owns AMD stock. Yeah, some very important things were said. So we're going to go ahead and react to that as well. I appreciate you for joining me as always. Thanks so much for being here. One thing before we get rolling here, I just need you to smash that like button. Hit that little thumbs up icon. Make it glow. Even if you're somebody that doesn't usually do that, can you please do it for me? Even if you're watching on the TV right now, please do it for me, man. That's all I need from you. Make sure you subscribe to the channel as well. For those of you looking to join my private group, that will be the pinned comment down there today. That's access to all my course curriculums, private Discord chat, 1000xstocks.com, the whole dealio. Alrighty, so honest, listen. If you watched the main channel last night, what did I tell you guys? If you follow me on X, always linked in the description area down there, what did I tell you guys? At that time, the stock was up like 5% after hours. I said, based on these numbers that they just posted, this stock is going to go insane, right? I'm like, this move you're seeing after hours, 5%. I'm like, this is small potatoes. This thing's about to go beast. And oh, did it go beast? I mean, what a day, right? Now, do keep in mind in regards to Honest, there's so many fundamental good things going on with the company that, you know, you look at the stock and it's been a beautiful move, but just understanding the question for me now is, based on like everything's better than I had even anticipated as a bull. Now the big question is, can the stock reach $10 by the end of this year, right? It is a super small cap company. $10 would probably put the market cap on this company closer to $1 billion, roughly $1 billion market cap, which based on where I see the net income going for Honest, about $1 billion market cap is pretty fair. And then also when I look at the balance sheet, talking about $100 million plus of cash on the balance sheet, no debt, with a company that's on the trajectory to likely earn $50 million plus a year in net income, in my personal opinion, that's where this company's headed over the next year or two, I think it's pretty fair. And their core business, their organic business, is growing very nicely, right? So I think there's a lot to be positive about in regards to Honest here, and I think the company's on the way to $1 billion market cap, right? And then from there, it's going to be a story of, can we get that market cap to a few $1 billion? And so, man, just really, really happy in regards to Honest. Honest is now in a great position also to be a buyout candidate, so do keep that in mind. Because think about it, if you're a big company and you're looking at somebody like an Honest, you're thinking, okay, we could probably strip out some costs. They got a phenomenal balance sheet. They're not debt laden, so it's not like you're going to acquire a company where you have to restructure the debt and all those things. You don't even have to worry about that. It's loaded with cash, right? Profitable, great margins on their products. So I think even a lot of big companies now will start looking at Honest over the next year or two and saying, man, that's kind of a cheap company. We should just do that as a little tuck-in acquisition, right? But we'll see what happens there. My hope is they don't sell the company, and if they do sell the company, I want $20 plus a share. So we're not even close to where I would, like a price. So just something to kind of keep in mind there. Elf on a shelf making a huge move here today. Again, right now the stock's deep into the 90s. So the thing you got to understand about Elf is this stock, in my opinion, as I've said many times, I think this stock exits this year somewhere between $100 worst case scenario, $140 best case scenario, right? And obviously this company has an amazing long-term opportunity. So when you look at a stock like Elf, the big thing you got to understand is don't get too caught up into just like, oh, where's the stock going this year? Like, keep in mind, Elf has a beautiful business for the next 5, 10 years, right? And it's an easy company to hold, a cosmetics company that continues to acquire brands, get bigger, grow those brands, become more successful. The Rode acquisition, as I thought it was going to be, was genius. And you're really starting to see that in the numbers, right? And so a company like Elf, you buy that stock and you hold that stock for the long term, right? You don't see me cashing out my shares here today, right? Like that stock could have been up 50% today, and you still wouldn't see me cashing my Elf shares. I have absolutely no interest. That's one of those stocks you buy and you hold, and you buy some more and you hold for the long term in regards to a company like Elf. And there's not a lot of those stocks out there that you really feel comfortable holding for a very long time. Elf is one of those companies. AMD with a nice upward move here today. That one's continued to see momentum. There was a little sell-off after the earnings came out because the guide wasn't that super exciting guide, right? 12.5 was expected. They came in at 13. It was kind of like, But then the truth came out. So the truth came out in the conference call. And this is why that stock didn't sell off harder, and that's why it started to rebound now, okay? Do you know what happened on the conference call? Lisa Su was pressed. The management team was pressed on the conference call about the data center business and only growing, 100% or so. And she then goes and says, like well above or something like that, right? Well above those numbers. And so they kind of pressed her. They put her in a corner a little bit, and she basically said, expect things to be much, much stronger than maybe even the numbers we're giving, okay? And that's what she led on there. And Lisa Su does not just hype to hype. Like if she says it, they're gonna do even better than what she says. And so that was one of those moments where it's like, oh, like if you can read through the tea tree leaves, as we say, like they just sandbag guidance. They're gonna come in and smash that. And so just something to kind of keep in mind there. And expect much more positive numbers for AMD over these next few quarters. And so, yeah, I wouldn't be surprised if AMD starts seeing more and more momentum, and that stock, next thing you know, all of a sudden 550 again, 580, 600. So just do keep that in mind, right? I mean, yeah, it's one of the most exciting stocks in the market. That's just like bottom line. Like you look at the numbers, A++ grade is phenomenal, right? Cheesecake Factory continues to see momentum. That stock now up to $107.58. Continues to be a value. And is it as good as value as it was when it was 30 when I started buying the stock? No, but it's still, a great company for the long term, right? Winning Resorts, I still got to listen to that conference call. It's one I have not gotten to listen to yet, but their earnings were good as far as that goes, right? Celsius, we're going to speak about Celsius in just a moment here. And then other than that, not too much that really catches my attention. Keeping an eye on Robinhood a little bit. Netflix still has me very intrigued. American Express still has me very intrigued. But yeah, Robinhood's one I'm keeping an eye on. But I really want to, like a stock like Hood, the time I'd really want to buy that is when. It's when the market's in a bear market. And so right now, can we say we're in a bear market? No. We can't say we're in a bear market. I mean, the NASDAQ right now, how much is the NASDAQ even down? The NASDAQ's not even down much at all, just to be quite frank. NASDAQ's down maybe 3% from all-time highs or something like that. That's nothing. So I want to, like a stock like Robinhood, I want to buy that stock when the NASDAQ's down 15, 20, 25, 30%. Call me in, coach. When that happens, I'll be very, very intrigued in regards to Robinhood. So, yeah. SpaceX continues to flounder. That stock, in my opinion, is going dramatically lower still over the next several months as those lockups come. So just do keep that in mind. And outside of that, big tech's kind of doing its thing. So, okay, so let's go ahead and talk about Celsius because that's a big subject here today with a dramatic drop, 18%, right? Well, what stock did I spend $71,000 on here today? Celsius Holdings is a stock I spent $71,000 on here today. I bought in one of my private portfolios. I bought 3,000 shares. This is a big buy for me. Big buy. $71,000 in a day, that does not usually happen, okay? I wish I had $71,000 to buy of a stock every day. But this was from the cash pile I've been stacking, and I was like, all right, we're going in with a big buy here. And so 23.67 is what I got those shares at. Keep in mind, whenever I come in with a big buy like that, I'm of the understanding I might not be buying the low. Who knows? Maybe Celsius bottoms at 19. Maybe it bottoms at 21. Maybe it bottoms today at 23. Maybe it bottoms at 22. You know, who knows? All I know is I believe I am going to look back at these 3,000 shares I acquired today at $23.60. And I believe I'll look back 12, 24, 36 months from now, 48 months from now, and be like, thank you for doing that big boy buy, because my gosh, was that a steal deal, right? And so do keep in mind, I'm not done buying Celsius either. I'm not done buying this one, okay? So in regards to Celsius here, right? Their income statement was a B- grade. I'd give them overall, which based on the price action, you would have thought this was much worse. By the way, this also speaks to, remember I told you guys I was a little worried about Celsius earnings? Why? Because of how weak the stock was going into earnings. I was like, man, does somebody know something? Whereas ELF I felt really good about, as I said, and the reason I felt really good about ELF is you watch the price action going into those ELF earnings, and it was just up. And people talk. Like people know some stuff, okay? And so looking at Celsius, that stock was so weak going into earnings, it made you think like, gosh, they've got to have some bad results coming, right? And so they missed the analyst expectations pretty much across the board, right? And so the stock went in weak to earnings, it exited earnings weak, right? And but at the end of the day, the numbers actually were pretty respectable. So revenue was up 11%, nothing crazy there. Now cost of revenue was an issue, that was up 18% for the company. So gross profit was only up 3%. SG&A, they kept that flat year over year. Did this distributor termination fee, which is a one-off-ish category there, that was $80 million. Keep in mind, that's not even like a cash expense for them because they get that reimbursed from Pepsi. So do keep that in mind. So it's not even like it's a negative. They have to put on their income statement because of GAAP standards, but honestly, it's pretty irrelevant. So if it wasn't for that, the income from operations should have been about $155 million, okay? So, which is quite better than this time last year, considering their cost of revenue came in so rough. So, you know, if you can still have your income from operations go up on a year-over-year basis, right? Once again, taking out that termination fee that, once again, is not even relevant for them, but they have to put it on there. Man, gross profit, you know, I think that's pretty darn impressive in regards to that, right? And so net income, diluted EPS were down big, but once again, it's because that one-off-ish, it's not even their issue to really deal with. That's Pepsi's covering that. So I walked away from the earnings feeling good about the long-term trajectory of the company. I listened to a conference call, I felt good about the long-term trajectory of the company, right? And so the right way, in my opinion, to look at a stock like Celsius, because numbers bounce around, it's like, oh, this brand's numbers are not that good, and margins are getting hit, and price cuts, or this or that, right? Competition, all these things, right? Is I owned Monster on and off from like, you know, kind of the 2010 era into like 2020 roughly, right? Now I own the stock on and off. It was a great company. Back then it was named still Hanson's Natural Beverage, and then they eventually changed their name to Monster Beverage. But over that time period, and this doesn't even show how dramatic some of the drops were, because this is charts just kind of looking on a month basis, so you don't even notice like how dramatic some of these drops really were, right, from the tops to the bottoms. But over that time period, like there was plenty of time periods with Monster that people were worried about market share, people were worried about competition, people were worried about lawsuits, people were worried about margins, right? People were worried about long-term TAM, competitors coming in the marketplace. And there was a lot of things always to worry about, but at the end of the day, Monster was just a great stock to hold, right? Great stock to hold. And it was a huge moneymaker over the years. And so I look at a stock like Celsius, and what I see is a company with multiple brands that has multiple growth levers to grow these brands, get more shelf space, go up on price a little bit as the years tick on, right? And expand the business international, massive. And so when I look at the company, I see exactly what I want to see. A company that is on the long-term trajectory to become a drink giant. And as of today, the market cap on Celsius is maybe $6 billion roughly. And I see a company that's going to be a drink giant. Drink giants, when we talk about market cap, we're talking about companies with tens of billions of dollars in market cap or $100 billion plus. And so there's a long trajectory, in my opinion, for growth for Celsius. And I also look at a company that is supposed to be in rough times right now, right? This is supposed to be like their tough times. Like, oh, this is bad, look at cost of revenue, blah, blah, blah. And I'm like, the company's still incredibly profitable. Like incredibly profitable during tough times. I like that. And so I see a company with a lot of growth levers. I see a company that the brands are in the good place for the long term. And that's why I came in, put some chips on the table today, right? You know, when you think you got the best hand at the poker table, you got to bet big. And I think I got a pretty good hand here, right? And so maybe I'm wrong. Maybe somebody's got a royal flush or something to beat me. But I think I got a pretty good hand here, so I'm going to put some chips out there, okay? All right, let's react to some Wall Streeters.
Yardeni's at 82.50 says that could be conservative. You've called it one of the healthiest, if not the healthiest tapes that you've seen in an awfully long time. Tom Lee says you could hit 8,000 this month.
Oh my God.
And earnings are the story. They're the story in all caps. Yes. Because the growth has been pretty remarkable, about 50% in the second quarter. If you strip out Google and Amazon and their investment gains, it's at 31%. July 1st, it was 24.4. So estimates continue and growth continues to go up, and that's driving the market.
So I have my contras. Do you guys have contras, like people that you know are always wrong, but you listen to them anyway because they make you feel better? You have like one or two? I know you do.
Yeah.
Sneaky, but like everyone. So I have my contras, and it's really helpful, actually. They have podcasts, so it's super convenient. I don't have to track down their comments on social media. I can just listen to a steady stream of it. And the people in 2024 that were lamenting the fact that it was a hyper-concentrated bull market, just Mag 7, it's all hyperscaler, right? Those people, and they didn't like the fact that the market was being driven at that phase of the rally by PE multiple expansion. Well, they changed their tune because now it's not. We actually have multiples compressing. What we have is massive earnings expansion all over the market. And so what they're saying instead now is earnings bubble. It's you can't win with these people. But again, I find that to be a helpful exercise. Let me listen to this guy. Everything he says is backwards. That's what they're saying now. If that's the problem, that there's too much earning.
I think I know who he's talking about. This was really funny.
I'll take it. And I want to be really specific here about what's going on. Let's take out Google and Amazon earnings because we know they wrote up their stakes in Anthropic and other startups, and that's not obviously repeatable or something that we want to get too excited about. Even if you pull those out, the S&P 500's earnings growth is still 28.8%. For next quarter, the analysts are already increasing estimates. Normally, analysts reduce estimates during the quarter. They lower the hurdle, make it easier for their coverage universe to jump over. They're not doing that now. For Q2 and for Q3, analysts spent the quarter revising estimates upward. They have to. They're listening to management. In the last 80 quarters, that's 20 years worth of data, the average change in estimates for the first month of the quarter has been negative 1.9%. That's the average. Right now, it's up 2.1% in this quarter for next quarter's numbers. These are unheard of times. So I understand the impulse. Oh, well, I can't be wrong. So therefore, it's an earnings bubble. I understand. I just caution people who are listening to that rhetoric from actually acting on it because it's been wrong all year so far. I think it'll stay wrong throughout the balance of this year. We have an earnings-driven market. All 11 sectors are reporting year-over-year sales growth, revenue growth. We're not talking about games, tricking people, stock-based compensation, buybacks. We're talking about sales growth of plus 14% in the quarter. You can't fake revenue. You could fake earnings, but that's not what's happening.
You and Tom Lee are on the same wavelength as he says, Malcolm. There are some investors criticizing S&P 500 earnings quality. Our analysis shows there are sizable contributions coming from investment gains, but keep in mind, to Josh's point, organic EPS growth is still 21% in the second quarter of 26 so far, and 2027 EPS estimates are still rising. We're dip buyers. We see the S&P reaching 79 to 8,000 this month. Make sense to you?
I don't disagree with the premise. I think that what the market is showing right now is that as long as the four main hyperscalers who are throwing trillions of dollars at the problem, trying to create as much compute as possible, continue to reaffirm their spending plans and also increase them, as we just got basically from all of them through the last earnings period, that is reason to feel bullish. It's obviously trickled down.
By the way, let me say this, okay? What JB just broke down there is very important. I think those individuals are important to the market. Those always have a negative spin on everything, right? I don't ever want the market to not have those people. I like having those people around. They make you feel more comfortable in the market, right? At least me personally. Like, some people might get scared out of the market, but me personally, I feel more comfortable. Like, I feel uncomfortable if it seems like everybody's bullish. And if everybody's bullish, then people tend to start to gravitate toward really bad stocks, and they get involved in really bad companies and get involved in a lot of messy situations and options and margin and leverage this and leverage that. And so I think they're a necessary good force, actually, in my personal opinion. So I don't ever want to see a day when we don't have those individuals.
Economics is going to go through the second and third order effects. All the different companies, Caterpillar, for example, is having its best year probably ever because of Microsoft, Amazon, Google, and Meta spending as much as they are on the build out. At the risk of sounding like one of Josh's beloved Contras, though, I will say I think that probably is through the end of this year. So
yeah, but isn't the point, though? Isn't the point that what was perhaps focused all around what you're saying is now broadened? Like, the earnings growth was a tech story and felt like it was a tech-only story. But to John Waldron's point, president of Goldman, who we ran the soundbite of yesterday, the double-digit earnings growth is propelling markets, and it's broadening out. It's no longer just a tech story. So I think that's sort of the point that
is Allstate and MetLife selling GPUs?
Allstate and MetLife, I really believe the story of insurance companies as an example of companies that are using AI, turning it on their businesses, weaponizing it against the problems that they once had, and using it to get more efficient. So their operating margins are getting far better. The point, though, is that the market only cares about one particular theme right now, and it's trickling through all the other different sectors that touch the AI revolution.
Well, I mean, it happens to be like one of the most powerful themes in the history of
I'm not saying that
the United States economy.
I think every bull market is that, though.
I'm not saying that it's not warranted, so I want to make sure that I'm clear about this. I think that we could get to 8,000 very soon because of the belief in what we're looking at right now. The question is, when does it stop? And I think that's the part that the bullish folks like a Tom Lee, for example, are not necessarily looking that far out and saying. They're saying this particular quarter, we get to 7,900, 8,000, and we'll see where we go from there. I agree with that. But I think beyond that is where we have to have the conversation of what causes that to slow down if the spending slows down, because I think there is a pull forward that has happened. There's a lot of companies, like I just mentioned, the four major hyperscalers, that have pre-funded a lot of their purchases for next year, this year. They've pulled it all into this year because they'd rather pay today's elevated price versus next year's elevated price. They'll take the known versus the unknown of next year's prices, and I think we have to consider how much of the additional spending at like a Caterpillar, I'll use them again, or a Corning, for example, those kinds of companies that are third order effects, how much of that spending that has reached them already is going to slow down because the companies accelerated this year and they won't do it again next year.
So you've highlighted the earnings story right now, and I think that's a good tailwind. 2 weeks ago, I put out a weekly letter to my clients, and I highlighted three things. Back away from the forest, got to see the trees here. And the three things that are important are worse is misunderstood. This was ahead of the Fed meeting. And I think that the expectations for hawkishness were really off sides. Right now, even still, there's expectations of better than 50% probability that the Fed hikes in September. Now, we do have a Jackson Hole, and we'll start to see a little bit more there.
What's off sides about that when the FT is reporting today, according to their sources, that he's prepared to hike in September if inflation remains hot? So it sounds to me like the market's exactly on sides.
It's not hot yet. So we're going to get more data.
Well, it is hotter than it's hotter than 2%.
But if you look back,
it's hotter than Target. You'd admit that, right?
Yeah, we looked at Fed Chair Powell and we called it coming to Harvard moment when he said specifically that oil price shocks are not to be controlled by monetary policy, and that was very bullish for the market. So I think they're going to try to look through the oil rise that we have.
Well, they obviously are, but there is inflation that is in other parts of the economy beyond oil,
and there's also disinflation within certain components within that. So I think the inflation, the non-farm payroll coming up, the inflation data, which what I believe will be next week or about a week and a half away, that's going to be critical. And I don't see that being a catalyst for a hike. Now, they are putting out, and when I say misunderstood, they are putting out these anecdotes that come off more hawkish in the near term. And I think that's going to become incrementally walked back. I think you're going to see that become a tailwind into the midterms, that being factor number one. Factor number two is President Trump, whatever he's going to have to do, they're going to have to engineer some sort of passage through the Strait of Hormuz, which is starting to show the market's going to find that favorable. Trump does not want voters at the ballot box in the midterms with the war taking place in the middle of the war and oil above $90. So I think that's going to be a tailwind as well. There's no better way to goose the economy when you look at those two. And then the factor number three is what we've learned from earnings, as emphasized it as well, is the market's compute constrained. The AI build out is very compute constrained. Alphabet even said on their earnings call that they're going to purchase more compute while they build out their compute. So and you look at names like Meta, they're leaning into, I think, being maybe a 2027 story, but they're going to sell compute. So I think the AI story 2 weeks ago when the SMH was what, 25% from its highs, we were looking at, okay, some of this is overdone, and these are the three pillars to be bullish at going into the midterms. And now we have this massive move off the lows in a very short period of time. Those three pillars have not changed. They are going to be the catalyst to take us to 8,000.
You know, it frustrates me how many people don't understand Meta. I'm like, oh my gosh, like I hear these people they talk on Meta like crazy. And as somebody that's been a shareholder of Meta for so many years, like, you know, I'm like, oh shoot, they don't understand the company. So listen, this is very serious in regards to Meta. Meta has a big earnings problem. And it's going to get a lot worse. And then there's people like, well, they might start selling compute, so they might have new businesses. Sweet, that's cool. The bases are going to be small. They're going to be literally not even meaningful to revenue or EPS in any way. And so for years. And so let's say Meta is successful in selling compute or these other new businesses. Okay, awesome. Those businesses aren't even going to be material to Meta's numbers in any way until you push close to 29, 2030, 2031. So in the meantime, you got a company that's earnings per share is declining and is likely going to get worse before it gets better, right? Because of the depreciation they're going to have to start taking. And they're also going to have some brutal comps coming up next year as well from a revenue perspective. I'm like, oh my gosh. So, you know, I'm just like, oh shoot, man, you know, people should dig in a little bit more. Okay, let's talk some AMD.
Got an outperform rating, a $600 price target on the stock.
And by the way, I'm bullish on Meta, obviously, over the long term. If I wasn't bullish on it, I would not hold any shares. But people are just way too excited about like, oh, Meta stock's going to go to 1,000 this year or next year. I'm like, you know, once I saw that CapEx number at the beginning of this year, I was like, that's out the window. No, we could have been, but the CapEx numbers and how crazy Zuckerberg's going with the spending, that took $1,000 right out the window. I was like, nope, that ain't happening anytime soon. Eventually, Meta will be $1,000 stock and probably a $2,000 stock, but ain't anytime soon. I can tell you that much because the spend is out of control, and that's going to continue to hit EPS severely.
Great to have you with us. What's your take on the quarter and why the stock is down by about 4.5%?
Yeah, you know what? I think it looks fine. Like, there's nothing wrong with it. I do think post Intel had some very strong results. Maybe people were looking for a little bit more. Revenue guide is decently above. The EPS that I'm getting is above. Gross margins in line. Maybe that's part of it, but overall, I think this looks great. They also said that data center accelerates into the back half, and I still think as strong as the Q3 outlook is, I still think the big AI ramp with Helios really is a Q4 story. So I still think there's that to look forward to. So I think it's just a little bit of heightened expectations post-Intel, but overall, as far as I can tell at least from the first glance, it looks fine to me.
You think we'll get some good indication on Helios and how much they expect to ship?
I don't know if they'll give us numbers or not, but at least qualitatively, I'd expect them to sound pretty good. I mean, they had an AI, they had the advancing AI, like almost like an analyst event a week or two ago. We got a little color there. I mean, they sounded very positive. It should be. I think it should be very positive. Should be fine.
Can the Helios stack actually chip away at NVIDIA and its position in the market?
Well, be careful about chip away. Like, are they taking share? Are they growing? Sure. I mean, they're going from not very much to hopefully a lot. At the same time, it's not like NVIDIA and frankly, like everybody isn't growing. I mean, and I think I've said this here a number of times, but I still feel like the right question is not so much who's winning or losing. Is the opportunity still big or is it not? I think if it's big, everybody should be doing great. And frankly, that's what we've been seeing right now. But I do think there was an opportunity for AMD here to go from what's been, good results, but still, not where they could be, to having a real inflection as the MI450 and the Helios rack starts to ramp into next year.
So as we see Intel and AMD compete on the server CPU side.
So what Stacy said there, listen, if you're an AMD shareholder, you want to buy AMD, listen. I actually agree with his sentiment there about these are really good results by AMD, but they're not quite where they're supposed to be, right? We expect this company to really just be smashing it. NVIDIA-esh, right? Like NVIDIA was a few years ago, where they would just come in, wreck their previous numbers, and just come in with a crazy guide. We're not getting that from AMD. We're getting very nice beats, but it's not like, oh my gosh, like, did you see what they just did? That was NVIDIA like 2-3 years ago. NVIDIA was coming up with such crazy numbers. You're like, wait, what? Huh? AMD's just coming in, beating the numbers, raising the guide, but it's not like, whoa. That's where I was talking about if they came in with a $14 or $15 billion plus guide, that was going to be the shock and awe. Everybody like, whoa, did you see? AMD just guided for 14.5 billion, 15 billion, and the stock, the stock would be 610 right now if that was a situation, right? But it's just kind of like, okay, like 13 billion, 12.5 was expected, cool. And so we keep waiting for that shock and awe, and we just haven't gotten it, man. And so at some point you start doubting, are we going to get the shock and awe? Are we going to get that? Right? Like next quarter maybe? Like, come on, man.
So you're saying it doesn't really matter. Like there's enough demand at this point where all the boats will rise.
Well, so those comments I just made were on the GPU side. On the CPU side, I mean, demand is so strong. Everybody's just shipping everything that they can possibly make. And you take Intel, for example. Intel, by their own admission, their products right now are not as competitive as they want them to be. It doesn't matter. Like customers are buying them anyways. A couple quarters ago, they actually had 200 basis points of margin upside because they sold previously written off products, stuff that they didn't think that anybody would want to buy, so they wrote them off. Customers said, we don't care, we'll take them. That's how strong demand has been. And I would say AMD actually has products that people actually want to buy. So I'd expect that to be pretty good for them.
What's your first question on the conference call?
I think the big question is, they said data center is going to accelerate into the back half. So, I mean, trying to get some color around what that acceleration looks like, the timing, the real timing of the Helios ramp. I think they've kind of said maybe end of Q3, but what does that look like into Q4 and next year? How much revenue do they expect from Anthropic, and what could that add to the numbers next year? And frankly, I'd also like to know about client, frankly. I mean, we've had client a little bit below like where the rest of the street is. I think I've been very nervous. Intel kind of talked about their PC revenues kind of taking a dive into the end of the year, and I would like to know the shape of that and how AMD feels about that. Although I feel like data center is strong enough where people probably don't care as much, but I would like to know.
Before we get to the big boss, Lisa Su here, okay? Now, I thought that was a very interesting clip from Stacy Rascon there, because did you notice what I noticed? He actually sounded pretty respectful toward AMD. We've come a long way, baby. We've come a long way. Like, that's a big turn versus where he was a year ago or so when he made those comments about, I don't even know if we need AMD, right? That was really max level disrespectful. And that's been quite a turn. Right now they got a $600 price target on AMD. How about that?
I think people don't understand that your stock is up so dramatically that it certainly makes sense that there could be a little bit of profit taking. It has far exceeded NVIDIA's stock price this year. So I think it's important that we start out by saying there was really no disappointment here that I could see.
Well, Jim, great to be here with you this morning. Great to see David and Carl as well. And yeah, it was a very strong quarter for us. We grew revenue over 50% year on year, and we're seeing just tremendous momentum, especially in our data center business, where folks need a lot more AI compute, and we have some great products coming. So very excited about the trajectory of our business and the momentum that we're seeing going into the second half of the year.
Let's go over something that was said in the call. I think that the analysts in the call, for the most part, were a little too negative. And at one point you say, look, I think you're hearing from us is that the data center AI number is probably too low. And maybe back to, and then mentioned an analyst question without going into exact numbers. I think the notion of over 100% should consider be well over 100%. So in other words, it's entirely possible that the analysts may not have heard exactly how strong your business is going to be.
Well, Jim, actually what I would say is we are in an extraordinary time for AI compute right now. We just updated our overall market numbers. We see the market for overall computing and high performance and adaptive computing going up to over $2 trillion as we go through 2030. And with all of that information, we wanted to reframe where our business is. And the fact is our data center business is accelerating. We're extremely excited about our foundational model large strategic partners like OpenAI and Meta, and we just added Anthropic to the mix there. And this is a case where, we do see our data center business growing well over 100% as we go into 2027. And
well over 100%.
They're just very large numbers when you think about, the base that we're on top of.
But also, I want to talk about CPUs. You guys have, as you taught me, you're just the CPU company. And it does seem that some of these analysts, I'm just harping the analysts because the stock's down today. Some of these analysts are somehow thinking that your CPU business, because it's lower margin, is going to hurt you. I don't see how that's possible. I think it's just 100% additive. Am I too bullish about AMD?
Well, I think, Jim, you're right on a couple of aspects. What we have seen in the AI market over the last, I would say, 6 or 7 months is really an inflection in demand, and especially in the CPU market. So what we're finding is as AI is becoming more useful for people, as we're using more agents, as enterprises are using, more of their workloads from, let's call it what was experimentation into now production workloads, people need a lot more CPU compute as well as, GPU compute. And we are the leaders in CPU compute. We're very, very, proud of our technology stack. We just announced our next generation. Venice has launched. And, as you know, our Italian cities very well, Venice is leadership across every aspect of compute, whether you're talking about I
want you to do something really important right now. I want you to look at the stock price, $475. Understand, just over a decade ago, when shortly after Lisa Su took over the company, the stock was $2 a share. It was a $2 chuck. What a story.
Performance or the most overall performance per core.
And now we have, a lot of people that have $1,000 and $2,000 price targets on the stock. My bull case has the stock going at $2,000 over the next few years. $2,000. And I think it was a $2 stock that was basically headed toward bankruptcy a little over a decade ago. That's crazy.
Is where, we just lead. So, we're excited about where the market is because the market needs a lot more compute. And we're even more excited about just the overall positioning in the market because our product portfolio is so broad and strong.
So, Lisa, as IT budgets get assembled for next year, how should people think about the enterprise state of mind? I mean, is it about sort of cost discipline and trying not to token max and being wary of our potential ROI? Or is it about just breaking some stuff and hitting the pedal to the metal?
Well, Carl, it's a great question. I think it's a little bit of both. And, the way I see it, spending time with a lot of CEOs and CIOs right now, the desire is to truly use AI as a tool. AI is a tool to help all of our businesses become more productive. And there is a good amount of experimentation where you're trying to figure out which is the right model that will get the best outcome from a business standpoint. But we are also in the place where, the AI costs are getting so large that everybody has to manage, just like you manage your employee costs, you have to manage your AI costs. And I'm a big believer in there will be all kinds of models that are important as you go forward. And that includes, using the largest foundational models, as well as using open models and let's call it smaller and medium-sized models as you think about all the different use cases. So I think the state of mind in enterprise today is how do I take advantage of AI while ensuring that I'm managing it for what will be significant growth going forward.
We have higher to go, ladies and gentlemen. Once again, the pinned comment down there today is if you're looking to apply, join a private group, you want to take your investing knowledge up to a much higher level than where you're at. You want access to all my premium courses. You want access to exclusive weekly videos from me. You want access to see the moves I'm making out there. You want access to 1000xstocks.com. That will be pinned comment. Click on that, fill out a form, see if we can get you access in there. Public count was down a little over $100,000, and I felt like that was a win here today. I mean, it could have gone a lot worse, and I mean a lot worse than how it went. Public count closing a little under $4.6 million here today. I had some stocks making some huge moves here today, right? Obviously, AMD, that was like the focus of the day. AMD, right? But there were some other stocks making some huge moves, kind of like on the DL. Like Shopify is my 5th biggest position in the Patreon portfolio. Not sure if you guys are subscribed to Patreon. It's always linked in the description. But that's my 5th biggest position. That one was up like 17% here today. I'm now up 118% on that position. Fubo had a huge day today. That one was up 11% plus. Wynn had a nice day, now closing over $100 a share. Now Elf on a Shelf after hours, falling slightly off a shelf, okay? And I mean very, very slightly. And we will be speaking about Elf in this video, okay? 5 core subjects in this banger of a video. I got a lot to get into in this one, okay? One, I'm going to share an underrated tech stock with you guys. It doesn't get enough talk, in my opinion, out there, and it's one of the best companies out there as far as an investment goes. Number 2, I'm going to talk about a travel-related stock that I absolutely love, okay, and the big opportunity there. Third subject we'll get into is a super small cap stock that is about to go insane, in my opinion. Their numbers they just reported, I'm like, oh my gosh, this stock's about to go crazy. I don't think people are ready, okay? 4th subject, we'll talk about Elf on the Shelf in this video, where Elf is headed from here. And then, and by the way, can you say green? And then we're going to talk about Dutch Bros. Dutch Bro earnings just came out. I thought that was an interesting stock to speak about here today. One thing all I need from you guys, if you could just do what the sign in my garage says, and please just smash that thumbs up button. I'm trying to keep you guys up to date on everything going on out there, and it's busy times, man. It's a banger of a video, and that's all I need. Make sure you subscribe to the channel. Make sure you got the notifications on, all that good stuff. And pinned comment down there today will be for those of you looking to join my private stock group, and you want to apply to join in there. That will be the pinned comment down there, okay? Listen. The most underrated tech stock, in my opinion, in the market that no one talks about. Everybody's always talking about Meta, Amazon. Tesla doesn't get talked about as much nowadays. Obviously, everybody talks about even OpenAI and Anthropic and NVIDIA and AMD, blah, blah, blah. But this company, Shopify, this is one of the best tech companies in the world. It's been one of the best investments you could make over the past decade. And people just act like it doesn't exist. It's unbelievable. This company just reported an A- quarter here. Subscription solutions up 22%, merchant solutions up 37%, total revenue up 34%. Now, as far as they had expenses a little high, but just slightly high, which kept gross profit from growing at a faster clip than revenue. So gross profit was up 31% for the company year over year versus revenues 34%. So 31% is still a phenomenal number, right? But we like to see gross profit growing at a faster clip than revenue, ideally. And that's why it's an A- and not an A+ quarter or an A quarter or something like that, right? Now, as far as other expenses, they kept everything pretty in check. They had this transaction and loan losses up 76% year over year, but that's a small line item for the company. All their major expenses, they kept those in check. Operating income exploded 68% up year over year. Net income up 66%. What an absolute banger of a quarter for Shopify overall. A- great there. Now, the issue with Shopify, the issue is people always look at this stock and they say, it's expensive. It's expensive. It's expensive, right? They look at it and they say, gosh, forward P over 100, 2-year forward P 44, it looks expensive, right? But keep in mind, it's expensive for good reason, right? It's not like it's just accident. The company's growing revenues at a 30% plus clip. A 30% plus clip, right? And they're putting this up like quarter after quarter after quarter. The company's growing their bottom line 60 plus percent. I mean, how many companies can you really think of that are growing revenues 30 plus percent and net income 60 plus percent? I can maybe, off the top of my head, I might be able to think of 2 or 3, maybe 4 companies that off the top of my head, I know like their revenues are going up at a 30% plus clip and their net income's going up more than 60%. That's a tough thing to do. And so it's expensive. Absolutely, Shopify is an expensive stock. But it's expensive for good reason. It's not like, are you going to get Shopify at a 15 forward P? No. But do they deserve to get do you deserve to get it at a 15 forward P? No, because they're growing revenues 30 plus percent and bottom line 60 plus percent, right? Now, keep this in mind. Very important. Shopify, since this company went public, right? You go back about a decade ago or so, this was a $4 stock on a split adjusted basis. And today you can buy the stock for $144, from $4 to $144, right? Back then, it was an expensive stock. The whole journey, it's been an expensive stock. The only time it probably wasn't a buy was during the peak kind of Rona days when, revenue was going crazy because everybody was forced to be home and everybody was starting Shopify stores and all those sorts of things. And then it had its tech bubble-ish crash where the stock crashed over 80%. But outside of that time, the entire time period for the stock has been a buy. Outside of that Rona kind of one-off, 12 to 18 months there, for the past decade, every month, every week, every year, this stock has been a buy, and it's just the way it is, right? So it's an expensive stock, but it's always been expensive. It's going to remain expensive. That's just how it is. The days when Shopify is not an expensive stock probably is the day you don't want the stock anymore because the growth will be done, right? And that looks like it's no time soon when you're still growing revenues 30 plus percent. All right, next one up here, let's talk about a travel stock that I love that's a big opportunity. Let me explain that. Then we'll get into a super small cap that's about to go insane, Elf on the Shelf and Dutch Bros, okay? Listen, Winning Resorts. I love this company. If you've been watching the channel for years, you know I love this company. A very special company. They just put up a very good quarter here, a B plus grade. Casino revenue was up 12% for the company year over year. Rooms were flat, basically. Food and beverage had a rough quarter. That was only up 1%. Entertainment, retail, and other was actually had a bad quarter. That was down 5%. But total operating revenues were up 7% because apparently people like to gamble a little bit, right? And as far as other expenses went, casino was up 12%, rooms was up 3%, and food and beverage up 6%. Not ideal, but they did bring entertainment, retail, and other down 12%, and they brought G&A, general administrative, down 4%. So that helped. So total operating expenses there up 6%. Operating income up 13%, so it grew at a faster clip than revenues. That's something we'd like to see, right? Now, they had this one-offish category here, change in derivative fair value, that was a $43 million help, okay? So that's just something to kind of keep in mind here. They also didn't have this big expense here, so net income looks like it went insane. But you got to understand there's some one-offs here that are helping, okay? So you see net income up 137%. It's like, oh my gosh, this is amazing. It's not quite that exciting when you factor in the one-offs, but it still would have been a great net income growth regardless of the situation here. So, very strong quarter from Wynn Resorts, B plus grade, right? Now, they got unlucky and lucky in the quarter, okay? So as far as Macau went, their table game win percentage was 17.1%. That was below the 17.4% that was in the same quarter last year. If you didn't know, casinos can actually get a little unlucky as well, right? Now, on the flip side, Las Vegas actually got very, very lucky. Las Vegas had a table win of 23.9%, which is severely above what their number was at this time last year, 21.8%. So they must be winning money from me or something at the Las Vegas operations. That's impressive, right? Now, the other crazy thing is here, the Wynn properties in Macau, this is the old properties, the old Wynn, the old Encore, right? They had adjusted property EBITDA of $95.5 million, right? That compares with Las Vegas, which just put up $215 million. And it's crazy because if you go back years and years ago, Wynn Macau used to crush the Las Vegas operations. And, you know, it seems like Rona was like some sort of like boom. And ever since then, the Las Vegas properties have just been amazing. Absolutely amazing. So, like, you have nothing but I have good things to say about the Las Vegas properties. They used to be seen as the negative part of Wynn stock a long, long time ago. And now you look at that and it's like, oh my gosh, like this is the most important part of Wynn, if you're thinking about investing, it's the Las Vegas properties actually, right? No, what's also amazing is if you look at the Wynn Palace, this is their premier property in Macau, that had adjusted property EBITDA of $201 million. The Las Vegas properties even beat Wynn Palace. That's incredible. So you want to talk about a well-rounded company between the Macau operations and the Las Vegas operations. That's pretty darn impressive there, right? Now, keep this in mind. The new property in the Middle East is supposed to open just over a year from now, September 2027. Now, this is the big, huge opportunity for Wynn. It's the biggest thing the company has going for it. This property is going to be 40% owned by Wynn Resorts, so do keep that in mind. So they have had to put like 40% of the money into this. In my opinion, as far as the physical look of the property, it's the only not pretty Wynn building they've ever done, in my opinion. And actually the only not pretty building that Steve Wynn's not part of this project. Obviously, this is a first project that Wynn's done that he's not part of. And I'm like, dang, man, shows like, but also do keep in mind, this is only 40% owned by Wynn, where usually they'll do 100% ownership, and things are a little complicated in the Middle East. The moral of the story is, though, this should be a huge hit. Like, Wynn properties are unbelievable. The service is unbelievable. And so it should attract the wealthiest individuals in the Middle East to come gamble at this property. And so Wynn should make fortunes of money about it. The only question, it's not a question of how much, will they make money? The question is how much money. That's the only question, right? And we really haven't seen a one-off kind of freak property like this be built around the world since Marina Bay Sands was built in Singapore. And if you don't know, that's a crowning jewel of Las Vegas Sands, is that particular property, Marina Bay Sands in Singapore. And so this is the closest thing we've had to that sort of opportunity, where it's like one property you can come gamble at, super high end, and in a region like the Middle East, I mean, I think it's going to do very, very well, right? It's just a question of how well. So that's opening just over a year from now. No, if you know me in Wynn Resorts, you say, I've always told you guys, anytime the stock goes under 100, it's a buy, right? And the further it goes under 100, the bigger buy it is. The new price, I would say, since this new property will be open in a year from now, is 120. So anytime this stock is under 120, it's a buy. The further it's under 120, it's a buy. Now, do keep in mind, if this property ends up being a banger, there's a potential that Wynn could climb to the $250 to $300 range. But we got to see what the results are. So you can't get too excited about this and be thinking about, oh, Wynn going to 250, Wynn going to 300, 2 years from now, 3 years from now. It really depends on how successful this property is going to be. It's going to be successful. It's just how successful. And, we can run projections. We can assume this. At the end of the day, they got to open the doors and they got to attract customers and they got to do business. And so we'll see, right? But under 120, it's a buy. The further it is under 120, the more of a buy it is, okay? Alrighty, next subject up here, a super small cap stock that is about to go insane. Then we'll talk Elf on the Shelf, then we'll talk Ditch Bros, okay? Listen. HNST on a stock. It's a $3.85 stock right now. I told you guys many times this year, I said this stock's going to exit this year at $5 plus, right? And the company's on the exact trajectory. After these results that just came out here in the last couple hours, I'm wondering if I'm going to have to change it to $10 plus. I'm seriously like, oh my gosh, like this stock's about to go insane, like literally insane. Like I don't think people understand like the momentum that this stock's going to see now at this point in time. Okay, here's what just happened. They just took up all their numbers and quite substantially. They took revenue to $319 million to $325 for the year, from $306 to $312. That's a pretty big uptick there. They're talking about organic revenue growth now of 5 to 7%, from 4 to 6%. They're talking about adjusted gross margin of mid-40s versus low 40s before, and adjusted EBITDA of $24 million midpoint versus about $21.5 million midpoint before. So they just brought up all the numbers. Things are going better across the board for Honest. And that's something you rarely see, where like the company takes up revenues, they take up margin, they take up profitability, they take up everything across the board. Phenomenal. Now, as far as the income statement they just reported, it was a B+ grade, okay? So revenues were down 11% year over year, but that's because they're exiting a lot of bad businesses. And it shows you how bad some of these businesses were, because cost of revenue actually fell 23%. Now, part of that is also helped with some tariff refunds, so do keep that in mind as well, right? Now, we'll talk about that in just a moment as well. But gross profit was up 7% for the company year over year. SG&A, they brought that down 27% year over year. That's a big number. That was a bad whistle. That was impressive. Marketing, that was up 15% for the company on a year-over-year basis. So hopefully that reflects in future quarters, right? R&D, research and development, they brought that down 12%. So total operating expenses down 12% there. Operating income exploded to 231% growth year over year. Net income was up 176% year over year. Diluted EPS up 200%. For Honest on a year-over-year basis. These numbers are phenomenal that Honest is putting up here. Now, what gets really crazy in regards to this whole Honest situation, look at the cash and cash equivalents. Keep in mind, this is a no-debt company. Their cash balance is up to nearly $106 million. Now, the company's gotten to profitability. So that number could likely continue to build unless Carla decides they want to do a big share buyback and buy back a ton of shares, or acquire another company, which that doesn't seem too realistic, although they could do that. This cash balance is becoming huge for a company on it. Like, this is a super small cap company. To be talking about no debt and $106 million roughly of cash and cash equivalents on the balance sheet, oh my gosh, this is becoming crazy numbers. Now you can say, I mean, imagine you have $100 million, sitting in treasuries, earning yourself 4%, let's say 4%, that's $4 million a year. They're throwing off to you just in interest income. It's pretty significant, right? Now, for Honest, it's a little over a $400 million market cap, right? With $106 million roughly in cash and cash equivalents. That's crazy. We're talking about basically a quarter of the market cap roughly is just in cash and cash equivalents. That's legendary, right? Now, as far as the tariff situation, they got tariff refunds, right? But even if you exclude the tariff refunds, adjusted net income still would have been $5.1 million, which still would have been up substantially on a year-over-year basis. And that's still a very good number. And so whichever way you want to slice it, and keep in mind, they also right now, they have, basically restructuring expenses here. That's kind of hurting the company. They had restructuring in the quarter that was almost a $400,000 negative hit for the company. So I like what I see a whole lot, right? Now, I posted this on my X page. Not sure if you guys follow me on X. I always have it linked in the description area down there. I said, Honest, watch this one tomorrow. It's only up 5% right now after hours. I would not be surprised if it's up 15 to 25% tomorrow. Net income was shocking. Margins are crazy. Raise the 2026 outlook. We'll see. But if that stock's up 15 to 25% tomorrow, I would not be surprised at all, given those results. I wouldn't be surprised if it sees momentum coming out of the gates and continues to see momentum as the trading day goes along, but who knows? What happens? All I know is it's a buy. It's a huge buy. Amazing buy, right? It's the most attractive super small cap stock I know of. I do not know of a company under $1 billion market cap that is more exciting, that has more upside potential than Honest. That's the one. Next one up here, let's talk ELF on a shelf, and then we'll get into Dutch Bros. Alrighty, guys, I hope you're enjoying this video. Here we go. ELF on a shelf. Here's the deal. They did everything I told you guys they were going to do. They came in with a net sales guidance that's significantly above what they were previously thinking. They took all the numbers up by $100 million for the fiscal 2027. Adjusted EBITDA, they took that up to the $400 million plus range. Adjusted net income, they took that into the 200s now at this point in time, right? Adjusted diluted EPS, talking about 350 to 355 now versus 327 to 332 previously. I knew it, man. I knew it. I'm like, well, just watch. They're sandbagging their numbers earlier in the year. They're going to play the same game they play every year. They sandbag in February, right? They do this every year. They sandbag in February or March, And then they come throughout the year, and the stock just goes higher and higher and higher. They reach a low usually, like in the second quarter. It's exactly what played out again this year. Low was hit in the second quarter, $49. And then from there, party time, right? And if I recall, guess the quarter the previous year it hit a low. Q2. And if I recall, the low last year was also $49. Isn't that amazing, right? And so is the stock going back to $49 next year? No. You had 2 years of $49, just say thank you. Say thank you, okay? That ain't happening again next year, I can tell you that much. This stock's about to be on a rocket ship ride. So party. 30 consecutive quarters of net sales growth, 7+ consecutive years. Unbelievable. This is a legendary run. One of 6 consumer companies out of 516 that have grown for a consecutive 30 quarters. The average growth rate per quarter, 20% range. I mean, these are incredible numbers. Now, one of the most exciting things about Elf on a Shelf is the international opportunity. So if you go back to 2020, 10% international sales was their makeup, right? 10% of their revenue was basically coming from international. Now it's up to 21%. When I say, oh boy, that's great. Yes, but there's a long way to go. Global beauty peers are like 70% international. So just understand, if you're wondering like, how can Elf keep growing over the years? Well, they're always innovating. They're always coming out with new products. They can go up on price. They can acquire more brands and international expansion. So there's a bunch of growth levers with Elf, which makes it, in my opinion, one of my favorite stocks in the entire stock market. Like if you watch my video where I graded a bunch of stocks like 3 weeks ago, roughly on the channel, I gave Elf one of my highest grades of any stock in the entire stock market, because there's growth levers for this company all over the place on how they can keep growing this business for the next 5, 10, 15 years, right? And what that's going to mean to margins long-term, profitability long-term is extreme. Now, $344 million of cash on hand now at this point in time, so the company's in a great balance sheet position, great income statement position. They don't need to acquire any other brands for a while, honestly, because they got Naturium, which continues to be a big growth brand. They have Rode, which has an incredible long-term opportunity. They obviously have their Elf brand, which has a big opportunity. They have the international. So my opinion is, for the next year or two, unless there's just something amazing as far as a deal to be had here, I think the company can just stack cash. I think they'll be able to put up great revenue growth for the next year or two without acquiring anybody else, right? Grow margins, grow profitability, and stack cash. I mean, absolutely stack cash to the sky. That's a company that's a position they can be in here, right? Now, you know what they got for a grade for their income statement? A+. An A+ banger. Net sales grew 36%. Cost of sales was down 26%. Do keep in mind, tariff situation helped that, tariff refunds, right? Gross profit growth of 63%. That's incredible. SG&A, that one rose significantly on a year-over-year basis. Keep in mind, as a lap numbers, once they get to 27, that should roll off a lot as far as the growth there. So these numbers should moderate majorly. So 43% growth in the quarter there. They had this change in fair value of contingent consideration. That was a $16 million hit here, but those are usually one-offish categories. Still, despite all that, 110% operating income. 110%. That's an incredible number. It's an incredible number. Oh my gosh, 110%. Jeez. Net income grew 100% for the company year over year. Diluted EPS up 93%. It's an A+ quarter for Elf on a Shelf. Now, this stock, as of right now, as of recording this, is an $83 stock. This stock exits this year, in my personal opinion, between $100 worst case scenario and $140 best case scenario. So this stock will continue to see momentum. Tomorrow is anybody's best guess. If tomorrow turns green, look out. Look out. Okay? So, Elf on a Shelf, phenomenal. And listen, two of the stocks I'm most excited about in the market for the next few years is Elf, and what's the other stock? Celsius, right? Celsius earnings will be coming out here shortly. I'll look forward to covering those for you guys, probably on the reaction channel. Jeremy Lefebvre makes money. But at the end of the day, I like to look for companies that have growth levers all over the place, have margin opportunity all over the place, and net income and EPS growth all over the place, right? And when I look at ELF, I see a company that has all of those in a significant way. And so I like that company a lot, right? I look forward to listening to the conference call on 1000xstocks.com tonight, because from what I heard, private group members really like the call. So I can't wait to listen to that one. I'll listen to Honest Call as well. I heard that one's a phenomenal call as well, okay? Alrighty, next subject up here, Dutch Bros. Is there an investment opportunity in Dutch Bros? Is there a lot of money to be made here? By the way, if you don't know Dutch Bros, they're a coffee shop that could be seen as a competitor to Starbucks. Their branding is very different. Their customer base can even be different and sometimes similar to Starbucks, depends. But they have their own way of fighting in the market. And if you experience Dutch Bros, you know it's a different experience than Starbucks, even though, they could sell somewhat similar products, right? But just Dutch Bros is just its own thing, man. It really resonates with, the under 40 crowd heavily. And they compete hard in the market, and they do a very, very good job. And they do big volumes, right? Now, the reason I thought it'd be interesting covering the stock, and if this is an opportunity here, is the stock's down big after hours, down double-digit percentage, right? Down 10+%, down to $58 after hours, right? Now, the first thing that I thought was very interesting here, I don't know if you guys have heard about this, but the Salad and Go company that has some locations in Arizona, Nevada, Oklahoma, Texas. Listen, I never heard anybody talk about the Salad and Go. Never heard anybody talk about it, but it just, from my understanding, is going bankrupt. And so it looks like Dutch Bros is going to acquire up to 65 of those locations. Now, that should help because Dutch Bros is basically in a massive expansion phase of their business right now, okay? And Dutch Bros likes to build standalone locations. They don't like to attach themselves to a strip mall like Starbucks did a lot of back in the day and these different plazas and things like that, right? Dutch Bros like to have their own little standalone location. They're very small. You can't even go into them. They're a very different experience than a Starbucks where you can go in and order and sit down and get on your computer and blah, blah, blah. Dutch Bros is not that. Dutch Bros has a window if you want to walk up, but almost everybody drives up to Dutch Bros essentially, okay? And so I think it makes sense that they want to acquire a lot of those Salad and Go's because a lot of those Salad and Go's are very similar size to Dutch Bros overall. So do keep that in mind, and it expects to convert those in 2027. And some of these markets that Salad and Go is at is actually some of Dutch Bros' strongest markets. Out here in Vegas, very strong. Arizona, very strong. Oklahoma, Texas, okay? Now, as far as the income statement goes, A- grade here for Dutch Bros. Revenue was up 32%. Cost of sales rose a little bit faster at 33%. SG&A was up 23%, so that wasn't too bad for the company. So total costs and expenses up 33%. So just slightly faster than revenues there. Income from operations grew 29%. So that's a very strong number, but it's a little less than revenues. Ultimately, you want income from operations growing at a faster clip. So if revenues are up 32%, you want income from operations up 35%, 40%. This is all stuff I teach you in all my course curriculums inside the private group and all those sorts of things. So if you ever want access to that, take your game up to a much higher level. If you're learning a lot from these videos, you're going to learn a whole lot more inside my private group. That will be the pinned comment down there today. Net income up 35% for the company on a year-over-year basis. Diluted EPS up 40%. So very good, strong quarter for Dutch Bros overall. It's an A- grade, right? Now, the issue with Dutch Bros, and keep in mind the valuation is going to likely come down tomorrow, but the issue is forward P on the stock is 70, right? 2-year forward P is likely 40. So, and you say, well, maybe those will come down a little bit tomorrow. That's possible. So maybe the forward P tomorrow comes down into the 60s, and maybe 2-year forward P goes to a 38 or a 37 or a 36 or something like that, right? But that's still a little expensive because you got to understand all these stocks are fighting for your money. Something I try to always teach you guys, all these stocks are fighting for your money, right? This one wants your money. We all have a finite amount of money. I don't care who you are. If you're me, if you're you, if you're Elon Musk, if you're Warren Buffett, everybody has a finite amount of money, right? Which means your investment opportunities are all trying to steal from each other. And so you have to look at a situation like this, not just is this a good stock to invest in? It's also, is this a better opportunity than this other stock over here? And that's why we also have the compare feature on 1000xstocks.com where you compare 3 companies all side by side so you can see, okay, is this really a better buy than this one? What's a better opportunity here? You can run your projections, all those sorts of things, right? So if I look at my beautiful Cheesecake Factory stock, the forward P on cake is in the 20s, right? Low 20s at that. And here's the deal. With Cake, I'm getting multiple growth opportunities. With Dutch Bros, I'm all in one growth opportunity. It's Dutch Bros and that's it, right? With Cheesecake Factory, I get an ATM machine of a business model with the Cheesecake Factory, but then I get two concepts that they're going to be expanding all over the United States, just like they're expanding Dutch Bros all over the United States, in Flower Child and North Italia, right? And so I like Dutch Bros. I just like Cheesecake Factory better. It's just a better opportunity overall, right? And so that's why I look at Cheesecake Factory and you're like, do you see me selling shares? Like, absolutely not. I have no interest because I'm holding a stock that has a forward P that's way too low given the sort of growth rates this company's going to have over the next decade, essentially, right? And so it's a strong, like Donkey Kong hold. I'm up $209,000 in this position that does not account for dividends received, and I have no interest at all in moving out of Cheesecake Factory stock. Okay. Now, let me just give some advice for everybody out there before I wrap today's video up, okay? We're in the earnings craziness right now. Every day, massive amounts of companies are coming out with their earnings, right? And all these numbers are being shown to you. Some are good, some are bad, some are okay, some are all over the place. In these short-term time periods, remember to focus on the long term. And whenever you're looking at these companies in terms of their earnings, say, is this company still headed in the right direction I want it to head long term? Not just, is this an A+ quarter today, right? But you got to say, is the overall company headed in the right direction? Do I have the belief in the management team that this company's headed in the right direction? That's what you really need to be looking at. Not just like, is this company a perfect quarter today? And they're an A+ quarter, so that means like, it's the best stock ever. No, because valuation also matters. Projections matter. And the long-term trajectory of the company. I've seen companies before that could report a crap quarter. Honest. Honest is a perfect stock, right? Honest stock you could buy that stock a few years ago for $1 a share. $1 a share, it looked like it was going bankrupt. They report F-grade income statements, right? You look at Honest today, it's the most exciting stock in the entire stock market that's under a $1 billion market cap. And, income statements are like a B+ grade. Borderline getting to A. What a turnaround. It's incredible. And so just understand a company can go from a really bad situation to a great situation over a few years span. And that's what Honest did, right? And so that's the main thing you got to be looking at, right? And so sometimes I'll buy into companies and I'll get a lot of heat for them in the short term because at that particular time, the income statements don't look the best. But I'm trying to judge it in terms of where's this income statement likely going over the next year, 2 years, 3 years, 4 years, 5 years, right? And many times I'm right, sometimes I'm wrong. And that's perfectly fine. That's part of the game. You're not going to win them all. Not in this game. You just got to win most of them, right? And the ones you really bet big on, those are the ones you really want to win, right? And so if you do that over the long term, you're going to do very, very well for yourself. So stay focused on long term. Make sure you're putting in the work. Listen to these conference calls. You get so much great information in these conference calls. It's going to bring you up to so much a higher level of understanding these companies, which is going to make you way less nervous when the market drops, when these stocks drop. You can feel comfortable. It doesn't matter what happens tomorrow. I'll feel comfortable. The S&P 500 could fall 20% tomorrow. Cool. Fine with me. Some great buying opportunities out there. I know what I hold. I know the companies I hold, right? The elf on a shelf could go down 20% tomorrow. It's not, by the way, but it could, right? Fine with me. I'll pick up more shares. I know where elf's headed over the long term. Elf probably turns green tomorrow, but we'll see. Honestly, it's irrelevant because Honest goes green tomorrow. I'm not selling. You think I'm going to sell? It goes green tomorrow and it's at 92, 22. You think I'm selling? Give me a break. Like that stock's headed to a $200+ stock price long term. So I have no interest. And so stay focused on long term, ladies and gentlemen. We got a lot going on. Going to continue to be a lot going on. If you enjoy learning from me and you want to learn on a much deeper level, then you can apply to join my private group. That will be the pinned comment down there. That's access to all my course curriculums, teaching you everything up here. So if you learn a lot from these YouTube videos, you're going to learn even a lot more inside there, right? And get yourself up to a much higher level. You can join the private Discord chat once you're part of that, right? You get exclusive videos from me each week. See the moves I'm making, 1000xstocks.com access to our amazing community of 6, 7, and 8-figure investors is phenomenal. That'll be pinned comment down there. We got to talk about some of these moves. Palantir's move was insane, 30%. Where's Palantir headed from here? Elf on a shelf, we got to talk about that one. That one continues to be insanely strong. Honest with a big move. A few other stocks I want to speak about in today's video. Then we got to get into AMD. Okay, AMD. listen, I'm going to show you my projections on where AMD's headed from here. We got a lot to talk about in regards to AMD, okay? From there, I want to go ahead and react to Tom Lee. Tom Lee, 2027 could be one of the best years for the stock market, says Tom Lee, who looks like he was just told that it's illegal to have this much hair. Then we're going to go ahead and react to this one, Ed Yardeni. Equity markets have fabulous earnings momentum. Looking forward to react to this one. Ed Yardeni looks like he was just told he cannot have dessert with his dinner here tonight. Then we're going to react to this one. Expect a volatile vacuum in the markets in August. This is interesting. Amy Wu. Okay, Amy Wu looks like her daughter just came home with a 98% on a test, and she's like, that's good, but why no 100%? And then we're going to react to Ross Gerber, who just looks like a situation. SpaceX is a compelling investment. Sell us on SpaceX, Ross Gerber. I cannot wait for this one, okay? I appreciate y'all for joining me. As always, thanks so much for being here. One thing all I need from you, if you haven't already done so, just smash that like button. We got a lot to get into here today. Subscribe to the channel. Make sure your notifications are on. It's busy times. We got a lot more earnings coming this week. We got Celsius, we got ELF, we got a lot, okay? Busy times, busy times. Appreciate y'all for being here. Oh, by the way, description area, I got all types of fun stuff down there. If you want to follow me on Instagram, if you want to follow me on X, if you want to have some free workshops, if you want to apply to join my private group and get access to all my course curriculums, if you want to join my Patreon, it's all in the description area down there, okay? Okay, so let's get rolling here. Palantir, listen. This move here today was ridiculous. 30%. 30%. But here's the deal with Palantir, okay? Listen. Remember, Palantir went into these earnings at a very depressed level. And so a move like this is short squeeze-ish, I call it, okay? Where it's not like that's the whole reason the stock went up, but this stock, a lot of individuals out there, including some big famous names, had been shorting this stock, right? And they come through with blockbuster earnings. And I don't mean Blockbuster, the one that went bankrupt. I mean just like amazing earnings, right? A++ grade, like you can't get any better than that, right? The guidance was the one worry spot in the respect of they are expected to start decelerating the revenue growth rate, talking about like 83% revenue growth next quarter versus past quarter was like 93%. So that was really the only thing you could really poke at in regards to earnings, right? So the move was insane. The stock was in a very depressed level. I mean, it went into these earnings like in the 120s, right? Stock has an all-time high of pretty close to, I think it was like 208, 210. So that's a wide gap. And so the thing I'll say about Palantir is exciting, but at the end of the day, it remains the same exact thing that I've been saying since last year. It's a range-bound stock, 125-ish to right around 200-ish. That's just what it is. And so it bounces. Everybody gets depressed about Palantir. It goes down to the 125-ish level, right? Everybody gets super excited about Palantir. It goes up to the 200-ish level. But my view on Palantir as far as the stock price goes, it's a range-bound stock. Fundamentals are just going to keep getting better. Revenues are going to keep going higher. But it priced in a lot of this. When we had that move last year to 200 plus, like you priced in a lot, right? AMD had a great move here today, but we'll speak about AMD, right? ELF on a shelf continues to be red hot. Remember, you could get ELF stock for $49 a share 2 months ago. 2 months ago, like June 5th, this stock was $49 a share. And now it's 87 and some change. It's almost a double now from the lows. We still got a little ways to go. Not quite a double, right? What is that, an 80% gain from the lows, 85%, something like that? From the lows, that's an incredible move for ELF. So the stock remains strong. Obviously, earnings are coming this week. You have to ask yourself, okay? Ask yourself a question. Listen, is there something strange going on here? Why is ELF seeing so much momentum? Why is it seeing so much momentum? Does somebody know something about the numbers? Does somebody know something about the guidance? Are they about to bring up their guide for the year, right? You have to ask yourself, when a stock is that incredibly strong day after day after day after day, right? When it's up, 80%, 85%, whatever from the lows. And I mean, we could be approaching a double up here soon, right? That's dramatic. You have to start asking yourself, does somebody know something? Does somebody know something? Why does that stock just keep moving up day after day after day, right? And we'll find out if they know something pretty soon here, right? Honest, a big move here today, 6%. Listen, Honest. that stock exits this year $5 plus, in my opinion, right? And I think we're on trajectory to get there. I wouldn't be surprised if after this earnings we go deep into the 4s and maybe we already get to the 5s here sooner rather than later. But we'll see. Celsius earnings are coming out. That one you're not getting any tells in regards to like, does somebody know something or something like that. The stock's actually been weak. So if anything, you can say to somebody knows something that numbers aren't going to be there or something like that, because that stock's been very, very weak. SoFi. I think everybody can learn a very important thing about SoFi. Okay, listen. You look at those earnings. Unbelievable earnings, right? Unbelievable earnings they reported. Stock goes down to $15, which is over a 50% downside move from the all-time high it reached last year of what, 30 plus, 32 or whatever. And the earnings were just unbelievable. Those moves are not lasting. Stocks over time or end up following the fundamentals, right? And so it made no sense why that stock went down, but it did go down. And ever since then, it's been coming back very strong. I mean, just in the past few trading days, SoFi stock is up, what, 20% or so? Just in the past few trading days. If not over 20%, like that. Happens quick. And so at the end of the day, SoFi's fundamentals are heading in the right direction. ServiceNow remains hot. Salesforce remains hot. Those stocks continue to see momentum here. So very excited about those ones overall. Whirlpool, got to look at those earnings. Looking forward to seeing what they have going on. You know, you're going to get a lot of people kind of coming into stocks like Whirlpool and RH, thinking about the thing I've been talking to you guys about for the last 6 months, about housing bottoms this year and housing comes back to life over the next several years, right? And so I think some people are trying to get in that trade, move, whatever you want to call it, position in before it happens. Because there's a lot of money to be made there. Like you could make a double up or a triple up if what I believe plays out, right? And let's say housing comes back strong over the next 3 years. A stock like Whirlpool could go from, it was trading at $35 here recently. It can go from $35 to $70 like that. And you get a double up just like that. And then, you get another move to 100. And so, but that's if that plays out. If housing remains dead, then that is what it is, right? But outside of that, Cheesecake Factory remains red hot. American Express inside the private group. You guys were asking some great question. Several of you asked a phenomenal question around P ratio, my expectations. I just answered that inside the private group. That was a high level question, man. You guys made me proud. Like I was reading that and I was like, I'm proud of you guys, man. You guys are on a high level. Like, dang, that was good. That's a good freaking question, what you guys asked there. So I'm very happy with that. Other than that, NVIDIA is showing some strength. Keep in mind, remember that stock was topped at 200 plus last year. So it's not showing like incredible strength, but it is showing a little bit of strength here in regards to NVIDIA. And I think the AMD results give NVIDIA investors a little bit more comfort. And then obviously Musk hyping out NVIDIA and the SpaceX partnership and all that gives a little bit of comfort in regards to that in the short term. So just something to keep in mind there, okay? Alrighty, let's get to the big dog. AMD. Listen. The income statement was an A++. This is amazing. 50% revenue growth year over year. Cost of sales up 16%. Total cost of sales up 15%. If your total cost of sales up 15%, but your revenue is up 50%, guess what? Your gross profit is going to go to the moon. And that's exactly what happened. Gross profit over doubled year over year to $6.2 billion from just over $3 billion the same quarter last year. Gross margin up to 54% from 40%. The only question is now, how high is that gross margin going to go? Are we going to head into the 60s, right? That's really the only question at this point in time. R&D was up 33% year over year. That's a much lower number than revenue. That's a dramatically lower number than gross profit. So that's good. Marketing and G&A up 41%, much lower number than revenue and much lower than gross profit. So that's good. Total operating expenses only up 32%. So we're talking about 18 full percentage points less than revenue was up, right? And a mile and a half from how much gross profit dollar was up. So, and then they also had other income of 510% there. Net income grew 163%. Good numbers, man. Really good numbers. Now, keep in mind, income taxes actually hurt the company this year. So they had income taxes last year. They had like a benefit, an $834 million benefit last year. They did not have that benefit this year. They had to pay income tax of $252 million. So right there, that's over $1 billion of hurt in the quarter versus the previous year, right? And despite that, net income was still up 163% year over year. So just something to keep in mind there. And then as far as diluted EPS, that was up like 190%, something crazy like that. Like, so it's an A++, like amazing numbers all around, right? This is what you want to see. You want to see your revenue skyrocketing with your gross profits dollar up even at a faster clip, right? And you want to see your net income at up even a faster clip, and you want to see your EPS up at even a faster clip. That's perfection. That's A++ there, right? Now, despite that, stock moving down here, right? Listen, it comes as no surprise to me, right? This is exactly what I thought would happen if they reported this number, right? And I talked about this, on X here today. If you guys follow me on X, I recorded a little video this morning after I got up, right? I said, if they come through with a guide that is anywhere remotely close to what analysts are expecting, the stock's going down big, right? And I said, if it's anywhere around like 13 billion, it's not going to be good. And sure enough, the guide came in 13 billion. And so that was not what I was excited for. That's not what anybody was excited for. We needed to come in at 14 billion plus. If we came in at a guide at 14 billion plus, that stock reaction would be, let's say the guide was, let's say instead of 13 billion, it's $14 billion guide. The stock would be up about 8% after hours right now. If we had come in with a banger, a $15 billion number, right? That was the big number. I was like, oh my gosh, AMD's going crazy if we come in. If Lisa Su came in with 15 billion, that stock's, 625 tomorrow. The stock probably exits a week at 650 plus. That's what we're talking about. But we needed to come in with a $15 billion guide. We just didn't come in with that, right? We came in at 13. And so, do keep in mind, listen, they're going to likely beat the numbers, right? They're likely going to, so they're saying 13 billion, potential at 13.3. They'll probably come in higher than that. So maybe they come in at 13.5. Maybe they come in at 14, right? They like to beat numbers at AMD. We do know that. But still, like, you wanted to get that crazy guide, right? And then come in and beat that crazy guide. So you wanted to see that like $15 billion number, and then they come in at like 15.5 or 15.7 next quarter, something like that. So yeah, so the stock being down doesn't surprise me given the guide, right? That just is what it is. The whole quarter was all about the guide, just to be quite honest. Now, where's AMD stock headed from here, right? We know where it's headed in the short term, right? Back into the 400s. But where is the stock headed over the next several years? Where you got to zoom out a little bit, right? So these are my projections for AMD over the next several years, right? My base case, just a fancy way of saying what I actually expect for the company. I expect revenue growth to be a little stronger than Lisa Su's expecting, right? So I'm thinking revenue growth of 40% on average per year, right? Keep in mind right now they're growing 50%, and that number is actually going to get significantly bigger as a percentage number over the next few quarters here. But over the years, right, keep in mind the raw numbers will get tougher and tougher, as they get bigger and bigger. I'm expecting 40% on average, right? 55% net income growth on average under my base case. That gets them to net income margins of 34%, which still isn't even remotely close to the ballpark that NVIDIA's in, right? You put a 25, 30p on the stock, it's still a $1,000 plus stock in a few years from now, right? Maybe even a $1,200 stock. Under my bull case here for AMD, I have the stock going to $1,500 to $2,000 come 2030. So that would be dramatic upside from a stock that's in the 400s tomorrow, right? And so, that's where you kind of got to zoom out a little bit. You got to zoom out a little bit in regards to this situation. Bear case would be they underperform not only my expectations severely, but they underperform Lisa Su's expectations severely, right? That'd be a bad situation. And then compound annual growth rate, we're talking about the stock come 2030 is like a $600 or maybe a $700 stock. That would be pretty bad, right? Like no one wants this to be a $600 or $700 stock a few years from now, right? Given that it's 500s today and tomorrow's probably in the 400s. So, it's the one good news I'll say is at least it's a buying opportunity for people that are looking to want to own AMD over the next several years. And so you kind of got to zoom out. At the end of the day, AMD is growing like a beast, right? We're going to have the big flippening happen here where AMD's revenue growth rates are going to start outstripping NVIDIA's revenue growth rates. So that's exciting, but man, I really want to see at least a $14 billion guide. But the 15 would have been the crazy number. And it's coming at 13. I'm like, So it is what it is. It is what it is. All right, let's react to some Wall Street.
Capital, as well as a CNBC contributor. It's August 3rd. I'm glad to have you here, and I'm glad to have you here at 6 a.m. Just to get your comments. I thought in July, last time you were on, you shook me because you said that we could have, before ending the year much higher, that we could have what was the drawdown? You said I could have gotten to a 6 handle on the S&P based on the numbers you were talking about.
Yeah, something that'll feel like a bear market, 10% kind of drawdown.
That's what you thought. It was not a good month for July, and you said that it was, even for what you were expecting, it was not as positive as you were thinking. But the averages didn't do that. There was a day where the Dow went down 1250. Who knows what's going on? That was an AI unwind for that hedge fund to explain it. Doesn't matter what caused it. It did get down, 7,200, nowhere near 6.
No.
Or maybe 73. How low did I'm this is off the top of my head. Is that enough now?
Well, I think August is a month to recover how June and July have been sort of flat months, but earnings estimates have gone up a lot. So the stock market's kind of a coiled spring. And then we had a huge deleveraging, as you're talking about, because of the AI unwind and Korea's policymakers panicking. So I think the markets could actually rebound strongly this month. Like maybe we get to 7,800.
This month, the 7,800.
Yeah, for the S&P.
Is that forecast for the 10% drawdown still intact?
Yes.
It is?
Yeah, so...
Can't you take that off the table? Just will you do it for me? Say it doesn't have to. No, I'm kidding. So we get to 7,800, maybe a 10% drawdown, and then close the year above 8,000.
Yes. Yeah, I think because as we start to look at 2027, there's a lot of the clouds that are heading this year kind of lift. The SpaceX unlock will be behind us, and the market testing of the new Fed will be behind us. So I think, and then of course there's already been a leverage unwind. So I think 2027 could be one of the best years for the stock market.
And you think part of the...
Whoa. We might have a big disagreement of opinion here. Listen, I don't want to call myself a bear for 2027. But we have to admit here, right? The biggest stocks that really move the market are the big techs, right? Meta, Amazon, Google, McDougal, NVIDIA, those sorts of companies, right? All this spending is really going to start hammering those companies hard in 2027, right? And it's going to really start hurting their earnings. You're seeing a little glimpse of it right now, even in these most recent numbers. And Meta got hit the worst, right? Profitability is literally going down for them now at this point in time, despite revenue rising considerably, 28%. Meta's numbers are going to get worse before they get better in regards to profitability. And then I think it's going to catch up with Amazon, with how big Amazon spend and the depreciation cycle coming for Amazon there, right? And Google, McDougal. And so I think you're going to have a 2027 will be scary from a perspective of like, oh my gosh, everybody's going to realize this spend is actually starting to significantly hurt EPS. That's going to be the realization that I think will set in 2027, which then there's already been a lot of questions about like the spend and like those sorts of things, right? And people look at AWS numbers and like, okay, we're giving Amazon a pass for now because the number's really exciting. Google's getting a pass for now, 82% cloud growth rate. But remember, you got to comp these numbers next year. That's the situation. You got to comp these numbers next year, right? And then, so you're going to have much more serious questions, because it's not going to just be a question of, are you getting an ROI on this? It's going to be, oh my gosh, you're starting to severely damage your earnings per share because of this. That's a much more serious conversation than, are you going to get a positive ROI on this? Or your product's going to be successful. When you start actually damaging the earnings per share, then you start questioning the multiple on the market, right? And so that's going to be something that has to play out next year, and I don't think that's being taken serious enough. And so, like I said, I don't want to call myself a bear for next year, but that's something you got to take serious, right? Then compound this with NVIDIA, Micron, the memory chip companies, right? AMD, like all these companies are, market caps are growing, probably will continue to grow as this year goes on, right? But once those companies' earnings per share really start getting hit and you start having those serious pushbacks and questions about what are these companies' earnings per share going to look at like a year from now, 2 years from now, right? Then people are going to start thinking about like, are these companies going to spend as aggressively in future years? And if they don't, what's that mean for NVIDIA's numbers? What's that mean for NVIDIA's margins? What about for the memory chip companies, right? What about for AMD? You're going to start having all those conversations. So then you could have a situation where all the tech stocks are like no one wants a piece of any tech stocks because there's like so much worries about semiconductor. So like I said, I'm not going to call myself a bear, but I'm just like, these are serious things that I don't think a lot of people are taking serious enough right now that next year people are going to start looking at it and be like, oh, shoot, right? So food for thought in regards to that.
The positive sentiment this month is going to be cooler inflation data. Why?
Yes.
Why? Oil's back up.
Yeah, oil's up,
Yeah, but
and we still have the tariffs working through, so those are hitting the CPI numbers, but the real driver of inflation historically has been housing and wages. And housing has really disinflated. We've had 3 months now of declining home prices. So you're taking out one of the biggest weights for inflation. And then I think wage inflation is really muted. I mean, we'll find out this Friday.
Hey, Tom, I just want to ask you what you think of the Leopold Aschenbrenner situation and the idea that he was highly leveraged 4 times, had to unwind this stuff. How much of that played into what you were just talking about with South Korea and the panic that happened there? How much of that was because he was selling that portfolio at the same time?
I think it was a big factor because, as you know, Korea is basically two companies, Samsung and Hynix, so it's memory and semis. He, of course, had a very large following. So not only was his leverage on his $45 billion, let's say it was levered to $150 billion, but there was a lot of money piggybacking on his trade. So I think in some ways, the unwind, and even last week, was due to a lot of funds being aware that he might have been in trouble.
That's an interesting whole situation there. Ed, your
make of it. Where's this market going?
It's going higher. I mean, my year-end forecast is 8,250, and all of a sudden that looks fairly conservative. It's only 6.5% away. I think we've got FEMO, what I've previously discussed with you, and that is fabulous earnings momentum. That's really what it all comes down to. I mean, we've got plenty of things to worry about in the Middle East with the Fed, and yet the economy continues to perform extremely well. It's resilient, and we're seeing that in earnings.
You're comfortable where earnings estimates have gone? I mean, if that's everything according to you, then that's everything about what risk lies out there too.
Well, I do watch analysts' earnings consensus very closely because I think that's really what's being discounted in the market, their outlook for the rest of this year going into next year. And that's called forward earnings when you take a time-weighted average of this year and next year. It's an all-time record high. I think it's going to hit over $400 a share by the end of the year, which will be the expectations for next year. Take 400 times 20, and you got 8,000. Pretty reasonable estimates. I think earnings are going to be somewhat better, and the valuation multiple may be higher. So I'm feeling pretty comfortable with that. Yes.
You had said maybe in the last week or so that tech had looked tired. It certainly looks like it's awake again now.
No, actually, on Sunday, I put out a note saying that information technology was on sale. So maybe that was an old note, but obviously you got to stay on your toes here with this market. But I actually pointed out that semiconductors were cheap, that the overall information technology sector was trading at the same multiple as the overall market. And that's unusual because growth stocks usually trade much better. And when you look at S&P 500 and information technology, it looks nothing like what we had back in 1999 and 2000. So all of a sudden, all this talk about this being a tech bubble is kind of thrown out the window.
I mean, there was that note out today from the gentleman at Citadel Securities who suggested, we worked off on our own the excess that was in the market. Now we're primed for a reset. No end to the fundamentals. Sounds like you agree with that.
Absolutely. I think that it is all about earnings. The valuation multiple came down because earnings went up, and investors felt kind of nervous about those earnings numbers, and they weren't paying up for it, and they actually took some profits. Now they're regretting it, and they're jumping right back in.
You like the broadening story?
Absolutely. We've been recommending market weighting information technology since the end of last year, and I think on balance that's actually worked out reasonably well. We've been recommending overweighting financials, industrials, and healthcare, and that's worked out very well.
Yeah, so you go through interesting times in the market, and if you want to know where money's moving next, my opinion is where money's going to move next is, if you look at the last few years in the market, right, it's been all about tech stocks. Ever since that bottom in 2022, in the fourth quarter of 2022, right, all about tech stocks. It was about the AI recovery. NVIDIA led it first, right? Then Meta started coming back to life, and Amazon, and you can go through the whole list of them, and everybody ended up going up dramatically, right, in regards to tech. And it's really been the play, and all the excitement about AI and the spend and all those sorts of things, right? And so my view is I wouldn't be surprised if we have like a conclusion of that this year, essentially. And I wouldn't be surprised if we move into a new age market over 2027, 2028, maybe even in 2029, where it's not all about tech stocks. And I believe there's a potential where those could actually take like the backstory, right? It doesn't mean those stocks are doomed and they're all going to crash. It just means like they become like not as exciting next year and after for a few years. And I think then you move to companies that sell like physical goods, right, which have not been the play for years now at this point in time, right? Smaller cap stocks, more mid cap stocks, and you see more and more momentum there. And you're already starting to see glimpses of that this year, right? Where some tech stocks, Meta is a good example, are very weak. NVIDIA, I think, is a good example. NVIDIA topped last year 200 plus, right? And you look at it today, it's what, 211, 215, whatever. It's like, that's, for NVIDIA, it's like, what's going on there, right? And so I think you're already starting to get some glimpses of this, like move to Russell, move to mids, move to companies that sell, physical goods and are not necessarily like tech companies. And so that's where those parts of my portfolio that I've been adding over the past year or two, I think will really benefit in a way that they haven't benefited for years, right? And so I think there's several stocks that come to mind when I think about like that next run. And they're not tech companies. And so something to keep in mind there. All right, next one up here. Expect a volatility vacuum in the markets in August.
Derivative strategy from RBC Capital Markets. And Amy, this earnings season has felt a little more volatile. Has it played out that way in the options market too? What markets? And Amy, this earnings.
So listen, I was in New York City a few weeks ago, right? And I'm trying to figure out, I never see any customers at these things. And I'm like, how do they make money? I'm serious. Like, how do they make money with all those little carts on the corner and whatnot? I walked that whole Manhattan area, right? Times Square, I went by Times Square like a billion times. I walked that whole Manhattan area down to Central Park, back, walking all over the place. I've never seen any customers, any of these little corner things, selling pretzels and selling these, I don't know, whatever they sell, hot dogs and blah, blah, blah. And I'm like, how do they make it? I'm really genuinely curious. Like, how do they make it? Because I never, like, am I like in the middle of the night? Do people go to that? Like, I'm trying to figure that out, really.
Has felt a little more volatile. Has it played out that way in the options market too? Watching the shares after hours, you see some really big hits and some really big misses.
Yeah, I will tell you, specifically when you look at an Amazon and when you look at a Microsoft, their one-day earnings realized move was the largest on record. So, pulling it back to all the previous quarters, I think it was plus 15% and plus 17% respectively. But overall, when you look at earnings seasons, specifically as it relates to the hyperscalers, they're beating these implied moves that are happening on options. And that's historically not the case. Typically, options tend to overprice the earnings move and then they underrealize. We're seeing the opposite this time.
The hyperscalers, though, we're not judging them the same way that we used to. This is This is an evolution that's taking place.
It's an evolution. It's not the hyperscalers you married. They're becoming different people.
Life crisis.
Maybe they're having an existential crisis. But look, two big things when you spend that much capex. And then you issue that much debt. They're far more rate sensitive, and they're far more sensitive when you think about that negative free cash flow. So it's not the same beast, and because of that, there really is a volatility regime shift, and how volatile these stocks will be going forward. That was not the same as the past.
What does that mean just in terms of how we judge them and how the market judges them?
So last weekend, one thing I wrote going into this week's earnings was, I think a lot of these implied moves that we're seeing are underpriced. And that tended to be what occurred, especially among the hyperscalers. I think that will be the case going forward, because you think a lot about these baskets that the quants have on, these factor baskets. I actually was updating our own high quality versus low quality basket. And I said, hey, a lot of these hyperscalers, they aren't going to make it into these high quality baskets anymore if one of your bogeys is you have to be really free cash flow positive, and they're churning and they're spending so much money, they're dropping out of these baskets. You're really rethinking how they fit in the factor world. And on top of that, they're shifting that volatility regime.
Does that mean their investor base is shifting as well? Is it a different investor who's kind of coming in?
I think I think it's
Google, Amazon, Meta, Microsoft. I would say a pretty high probability they're all free cash flow negative in 2027. Pretty high probability.
Slow moving ship in the sense that people have them, they're such large concentrations. But when you start to change that volatility regime, you'll have new people coming in, but two, you might have people leaving who are targeting certain volatility bands. And so those things are shifting. I think next earnings season will look more similar to this one than past ones, in that those option implied moves have to start picking up from where they were.
Joe was just asking the question in the beginning of the show. Have we made it through the volatility factor or the frothy factor in the markets? Just the concern about AI, has that kind of played out at this point or not?
So yes and no. I think near-term froth, you did get a lot of shakeout just because of what occurred with situational awareness last week. One of our monitors, so absolute skew inversions, essentially the absolute count in the S&P 500 of how many stocks where the call implied volatility is outweighing the put implied volatility. That high's around 80. We're sitting about 50 right now. So about average levels. That tells you froth has been sucked out of the market. However, as we get past this earnings season, August tends to be a volatility vacuum, and then we hit into midterms. I would expect some of that to reoccur.
There will be a season 2. They're working on it right now, probably the producers and the writers, showrunners, and everything else. I would imagine that too.
I think there'll be a season 2, Joe.
There will be a season 2. Yeah, sometimes it takes a long time. It was Severed, it was like 3 years. Hopefully,
Severance.
Yeah.
Great show. I was like, Severed.
Yeah, Severed. Yeah, Severance. It was like 3 years. I forgot what happened.
Yeah. The rewatches.
What else should we watch as we kind of move out of earnings season into the dog days of summer, maybe start heading towards fall?
So we were on a client marketing trip these past few weeks, and what I thought was interesting is people are starting to bring up midterms fairly early. And here's the context in which they're bringing it up. It's not about consumer sentiment. It's not about these high gas prices, inflation. It's a lot of anti-AI sentiment. So, we sat down, the client across from me said, look, what do you think about this moratorium that Kathy Hochul's put on data centers? And so it's interesting to see this divergence in sentiment that you're seeing in the U.S. that's not necessarily there in China. And the question we've been writing about, which I don't have a great answer to, is this a political thing, or does it become an incumbent versus not incumbent thing? We don't know how it will play out, but when anti-AI sentiment is something that happens in midterms, it ends up being more of a market story, just simply because of the concentration that you have in all these names.
I mean, you might also have the states versus the federal government in some of these issues, too. The federal government has been mostly hands-off. The rules they've talked about, the regulations at this point are voluntary, coming from the White House. But then you get a real big push from the not in my backyard, and that may be more of a local story.
It's interesting because one of my notes was literally called NIMBY, not in my backyard. So the point being, on a federal level, obviously we have stakes and we want to pursue, we want to beat China. There are these reasons for doing it. But at the same time, you don't want the data center to be what you're staring at from your bedroom window. And so there is this dichotomy and this tension between what's occurring local versus on a federal level. And I think that tension will probably start to break out more in midterms.
Yeah, you know what? This is actually really interesting because I just saw something yesterday in my city. In my city I live in, they just canceled a data center that was supposed to be built behind the mountains there, and I don't know why. I couldn't find the reason why it didn't go through. It was like something that was supposed to happen, and so it's not happening. And so, yeah, I don't know. It's interesting. It also reminds me of talking about midterms, politics. If I recall, T-Man's in my city today too. I think he's over by my old house, if I recall. All right, next one up here. SpaceX is a compelling investment. Ooh, this is gonna be fun.
Much usefulness it is to even go through some of the numbers on a quarterly basis backwards looking. I know a lot of investors are looking to figure out kind of whether Starship sort of fulfills that promise and whether what's going to be attached to these rockets, presumably whatever sort of servers and other sort of orbital data center type of equipment, are going to be along for the ride sometime soon.
Well, I think it's going to be sooner than what people think, judging from the last Starship flight that we saw, which I would consider pretty successful. And when you look at the size of this thing and the fact that they're now getting it in and out of space without exploding and landing pretty well into the water, we're pretty close to having a reusable massive rocket ship, other than many of the...
Whoa. Hold your horses, one flip and flapjacking moment. Listen. Pretty close could be years away, okay? Like years away. We've been pretty close on solving full self-driving for years. And yet we're still not there. So like pretty close is like, dude, that could mean we're still 5 years away, 10 years away. So that's just ridiculous. Like you can't say things like that when it comes to technology like this.
The technology challenges that they still face to get this to work, let's say over and over again in scale. But just the fact that they've gotten this far is very encouraging. And I don't think people should doubt whether or not this is actually going to happen. It's just when.
Yeah, and I think that seems to be the consensus, and we've certainly seen some degree of a proof of life with regards to that ship. The question, though, becomes in terms of monetizing this further beyond just being sort of a taxi service, if you will, into space. How much of this gets monetized by SpaceX itself with regards to what it's able to put there, and that flows back into the company for its own coffers?
Yeah, and I thought it was interesting because I thought the most important announcement from SpaceX was their deal with NVIDIA to build these, they're calling them star mine data centers in space. So really they're putting the hardware pieces together to do something that's never been done before.
Listen. That's all just for branding. Give me a break.
Which works because they have Starship and they have...
Oh, I feel bad for people that believe this. It's all just branding. Are you kidding me?
Starlink. So by putting the data centers in space, it really adds a whole new element of what can be done through Starlink as far as not only just connectivity and internet access, but also sending and receiving data. So it's a very exciting, idea or premise to be able to do this, and only SpaceX can do it. And I think that's what makes this investment compelling. Isn't really what it's doing today, but what will this look like in 5 years? And it could be pretty damn impressive.
Were you surprised that they would make that announcement on with regards to NVIDIA and using those Rubin GPUs?
I wasn't surprised because they have a very close relationship with NVIDIA. What I'm surprised about is how rapidly they're moving forward with the development of these satellite-based data centers, which, obviously has never been done and is the challenge from a technology perspective is massive. So they're moving forward full speed ahead. And I think it's a really exciting prospect, and it's a high risk investment because obviously all these things can fail. But on the other side, it's a high reward investment if they succeed. And so I think investors need to weigh both of those cases when looking at the stock today. But considering it's trading below the IPO price, individual investors who want to buy the stock certainly are getting it at a discount compared to everybody else.
Let's talk about the AI business, obviously created after he merged xAI with SpaceX. We should point out they're also saying in the release that they do plan to close the Cursor merger sometime this quarter, in the third quarter. This has been a bit of a drag, and it seems like there were a lot of investors.
We should start building Teslas in outer space too. And then like start flipping flapjacks in outer space. Like, why not? We'll just do it all. Right?
That would have liked to see SpaceX go public with just the launch business and the connectivity business, and not necessarily xAI. Are you comfortable with maybe what his vision is for how xAI fits into all of this?
Well, I've been sort of, xAI is a painful thing because I sort of think Tesla should have owned xAI, and I know Elon didn't want Tesla to own it because he didn't control Tesla. So, well, he does, but shareholder-wise. And so xAI is a part of SpaceX. But the way I look at it is Elon is really good at building factories in AI, and xAI is going to be successful whether they use the compute or sell the compute. And so the fact that SpaceX or xAI is investing, billions of dollars into building these data centers, it's going to pay off one way or another because the demand for compute is so much larger than the supply of compute. And Elon's super good at this. So, I think investors are so short-term minded to be worried about CapEx during this incredible technology boom period. We would need the CapEx to be spent if we're going to be competitive, and that's exactly what SpaceX is doing. And I think if you take xAI out of the business, it's more profitable. It's easier to sell on the short term. But on the long term, you're missing one of the great opportunities to be able to provide compute from space, which is actually, potentially massive as far as an opportunity. So, I think it should be part of SpaceX, and investors just have to be patient and let this stuff play out.
Starlink coming in, 12 million subscribers at the end of the second quarter. It's only profitable business. The company says it has ARPU for Starlink of $66 for the most recent quarter. This is kind of the one part of the business that doesn't really have to prove itself. I am curious as to whether there is a growth story for Starlink, or has it already sort of matured?
Oh no! Starlink is just beginning.
This actually, that's a bad miss right there, because this is the one business that you got that's actually successful, and so the fact that missed is like, okay, our one successful business missed.
So many ways, Starlink is a critical system, and pretty much everybody in America should have it as a backup for their internet access. As a fire survivor of the Palisades fire, Starlink saved us. Without Starlink, I can't even tell you what would have happened during that fire. So it's literally a life or death critical system, and you should have it as your backup internet. So there's a massive market even in America that doesn't have Starlink. And then when you talk about globally, it's huge. But there's another element to Starlink that people have to understand, which is the military element to Starlink, which is one of the reasons Ukraine is having so much success with their drone attacks all throughout the country of Russia, is because they now have Starlink satellite antennas on the drones, and same with the U.S. drones. And by doing that, it gives us a guidance system that's global, that can be managed anywhere in the world, and it creates a weapon that is almost unstoppable. And we're seeing this right now in real time. And this is due to Starlink. So the military side of Starlink is only also just begun, because we haven't even built that many drones yet. Like, if we're going to be prepared for the future of combat and war into the 21st century for real, Starlink is going to be just a critical element to our military and our success in this new autonomous, military world. So Starlink is just at the beginning, whether it's, internet service on a boat, or a backup service at your house, or putting it on a drone to go blow up the Wildberries factory in Russia. This stuff works incredibly well, and I just there's no competitor.
I want to watch this video inside the home of YouTube's biggest finance creator. That looks like a banger video. I want to watch this video. I rank the best stocks you should buy right now. That looks like a banger video, right? Okay, SpaceX. In all seriousness, here's a stock to buy. Answer: absolutely not. You gotta be flipping my flapjacks. No, of course not. It's not a buy. Someday it might be. Someday it might be, but it ain't today. It ain't today. Once again, linked in the description area down there. I got a bunch of fun stuff. Want to follow me on Instagram? Want to follow me on X? I got that down there. Want to join the private group or apply to join the private group? That's down there. Want to join my Patreon? That's down there. Free workshops? That's down there. All types of goodies, all in the description area. I'm going to try to keep you guys up to date with everything going on. And man, we got a lot going on out there. Listen, public account. We're a sneeze away from an all-time high. We're getting pretty darn close, okay? $4.533 million, up $121,000 here today. That's a holy smoke. This ain't no joke. Congratulations to everybody at all-time highs in your portfolios, or pretty darn close. Oh yeah, baby, we're gonna be breaking some records here shortly. Look at SoFi here today. Another 10% move up for SoFi. That one continues to see very strong momentum. $9,500 move there. Meta was up $33,000 for us in the public count here today, 6% move. Amazing Zone continues to run. $19,000 plus move. That one's now at over a double up in the public count, up now up $222,000. You know I love all those twos. Cheesecake Factory with a legendary move, another $11,000 up here today on Cheesecake, 3+%, up now 157% on the cake. That doesn't even include all the dividends we've received over the years in this stock. So congratulations to anybody that's been along for the Cheesecake Factory ride. ServiceNow continues to run and see momentum. That one's now up $17,000 for us in the public count. AMD, are you ready? 600 plus this week, baby. We're ready to go there. We're ready for 600 plus this week. AMD now up $953,000 on AMD stock. That one continues to move and groove. I posted this on X. Not sure if you guys follow me on X. Got 200,000 views. I think this was a day. No, this was, how many days ago was this? This was like, I think 5 days ago now or so, right? I said SoFi and AMD are looking tasty today. Heck, MU is even tempting at $777. I mean, AMD that day reached the low 400s, right? SoFi that day was $15. MU that day was under $750. What a move up for those stocks. 3 core subjects in today's video we're going to speak about. Palantir. What's going on with Palantir? Where's that stock headed from here? 2, I'm going to give you, I've been wanting to do this for a while, my ultimate 10 stock GVD portfolio. What 10 stocks would I put in it? I cannot wait to share this with you guys here today to try to build the perfect 10 stock portfolio. What would I put in it? We'll speak about that, okay? And I'll show you every single stock I put in it. And the third subject up here is I got 3 stocks that are ready to move huge, and my expectations for these stocks and how big and drastic the moves will be. Listen, I prepared this video. I just got home, okay? I prepared this video in the middle of the desert. It was 118 degrees outside. I had to have my wife drive, okay? And all I need from you to do is just smash that like button. Hit that little thumbs up icon. I hope you can do that for me, okay? Make sure you subscribe to the channel if you're not already subscribed with the notifications on. All that good stuff. That's all I need from you, man. Prepping videos for you guys in the middle of the desert. Come on. I got a bunch of goodies for you guys in the description area down there. If you're looking to apply to join my private group, I got that down there. If you're looking to join my Patreon, got that down there. If you're looking to follow me on Instagram, I got that down there. If you want to follow me on X, I got that down there. And additionally, I got a bunch of free workshops for you guys down there as well. So enjoy all that fun stuff in the description area. Palantir. Listen. Legendary. Palantir just reported 93% revenue growth on a year-over-year basis. I mean, it's insane. Absolutely insane, legendary numbers Palantir's putting up here. Income from operations, the income from operations margin was 47%. Adjusted income from operations margin was 62%. Cash from operations, 63% margin. Net income, they had a net margin, ladies and gentlemen. Net margin, 55%. I mean, when I got in the stock market, I'm going to date myself here, okay? I got in the stock market 18 years ago. Listen, no one had 50% plus net margins. Give me a break. That wasn't even, you couldn't even conceive of that. When I first got in the stock market, if you were a great company, you had net margins of like 20%. They were like, you're special. 20% net income margins. Wow. Now you got a company like Palantir coming with 50% net income margins? It's ridiculous. Absolutely ridiculous. But good for Palantir, okay? But listen, let me throw some cold water on everything because it's about to happen. The thing I've been saying, it was going to happen either this quarter or next quarter, it's here, okay? And that is their guidance. The guidance came in at $2.162 billion, okay? Now, that midpoint's at about 83% revenue growth. An insanely strong number, right? And keep in mind, they'll probably come in and beat that. I don't know, maybe they'll come in and do 85, 87, maybe they'll come in and do 90% revenue growth. But the issue is they're now projecting for the revenue growth deceleration phase to start. Okay. And that's a fundamental change than what Palantir's been going through for really the past like 3 years or so. The past 3 years, Palantir basically almost every single quarter has been accelerating the revenue growth rate. Accelerating, it's just getting higher and higher and higher and higher. And it looks like we finally reached a peak of the most insane revenue growth we could imagine, 93%, and it looks like it's going to start going down as far as the revenue growth acceleration. So we'll likely head into the 80s as next quarter, then probably into either the 60s or 70s in the next quarter, and then we kind of go down from there. And so Palantir's still in a position to put up great growth for years to go in the future. Let's not get that confused. But the deceleration cycle is beginning, and that's a big fundamental change for the business model overall. And it's very important everybody understands that. It's a high level subject, so I understand if people are newer to the market in the first few years, you're kind of like, oh, what is this revenue growth deceleration? It matters significantly, right? And so just something to keep in mind there. Now, as far as the income statement goes, A++. 93% revenue growth, cost of revenue up 54%. That's 102% gross profit growth there. Sales and marketing 39%, R&D up 43%, G&A up 19%, total operating expenses up 34%. That's nothing when your gross profit's up 102%. Income from operations exploded to 239% year over year. Net income up 224% there. That's insane, man. Legendary. I don't know where to put it. What? Numbers are crazy. I almost think it's better than that, actually. I think my calculator might have been broken. 215% EPS growth there. Commercial revenue growth, 149%. Now, here's a little test for you guys. We'll see how high-end folks are, right? Well, the first test with Palantir is like recognizing, okay, we're about to start a revenue growth deceleration phase, right? The next one to recognize here is you got to look at something like this. You got to say, what is weird about this, right? Commercial growth 110%, but U.S. commercial growth 149%. This one's simpler, but for new investors, sometimes they might be like confused by this. Listen, what does that mean? You should your brain should be like doing some alarm bells. What it means is international is hurting the company. That's the thing that's holding back the growth rates from being even more insane. The U.S. commercial guys are buying Palantir's products like hand over fist, right? 149%. So for Palantir to come in with 110% overall revenue growth, it just goes to show like how much more the U.S. commercial is bailing out the overall numbers for Palantir. International is really holding back the company in a significant way, right? Now, additionally, here we go again. What do we notice? U.S. government revenue growth 90%, but government growth overall 79%. So we got to hold back again. It's international. So for whatever reason, either Palantir is not doing a good job of selling outside of America, or the companies and government agencies outside of America refuse to use AI products, or Palantir's branding issues outside of the United States of America, and that's holding them back. My hunch in regards to this is Palantir has a branding problem outside the United States of America. I mean, Palantir's got branding problem in general, okay? But when I say a branding problem, I'm really talking about from society, right? A lot of people don't trust Palantir. They don't like Palantir. They view it as not a good company, those sorts of things, right? And it's a much more extreme level in the international markets. And so that's definitely holding back Palantir's growth rates from being even more insane, right? No. The positive spin on this is, hey, eventually the international guys are going to have to catch up to the story, and they're going to have to get Palantir's products, right? It's get Palantir's products to be left behind. Now, there is something I think is worth looking at here that I think is a little, I don't want to call it scary, but it's worth looking at, right? I was looking at U.S. commercial customer count growth. They reported a 9% quarter just a few quarters ago, right? Now they're down to 6%. As far as customer count goes. So customer count is definitely slowing down in regards to the percentages, which means you'll probably start getting raw number slowdown significantly, I would say likely in 2027. So just something to keep in mind there. Customer count in general, there were 7% growth just a few quarters ago. Now they're down to 4%, right? So my opinion, what you're going to start seeing in 2027 is the total customer count slow down significantly. So it's not like, oh, there's no one to attract for new customers. I think you're just going to see a much more of a slowdown from that, right? Now, as far as the balance sheet goes, amazing balance sheet. $9.2 billion in cash, cash equivalents, U.S. Treasury securities, and no debt. Legendary, okay? Now, I'll say this, and then we'll talk about what I'm going to do with Palantir stock. Listen, the forward P on Palantir's, I would put in a ballpark of 75 to 85 now at this point in time, okay? I think that's very fair, and that's even given tomorrow's likely move, right? Now, my 2025 call on Palantir, if you've been following me for a while, is this stock's going to be stuck between about 125 and 200 for years. That's what I've stated, right? Does this change my opinion? No. The stock is still going to be stuck, in my opinion, between 125 and around 200 for years to go in the future. And so, because the first cycle we had to work through was valuation. Valuation is not the biggest concern now. 75, 85 4P is insanely rich if you value it versus market, but not based upon Palantir's growth rates. But now we're going to go into a new cycle of a problem. And this is why Palantir, like let's say you want Palantir to go $300, $400, $500 a share. What makes it very difficult to get it there is customer count's going to start slowing significantly next year. It's already as a percentage started slow, but the overall number is going to start to slow significantly next year based upon the numbers and just looking at the trends here, right? And additionally, the deceleration will get much more severe as the quarters go on, right? It's just math. It's not like it's, some random guesses. It's just math and how these cycles work. And so that's going to also put a lid on the stock. And so at the end of the day, Palantir remains, even with these banger numbers, great numbers again, it remains a stock stuck between 125 and about 200. And so that's just what you're going to see for the next several years. You're going to see it for the remainder of this year, next year, the following year. People get excited about Palantir. They're going to bid it up to that 200-ish range, right around there, right? They get depressed about it. They're going to send it down to 125-ish, maybe slightly lower than that. But at the end of the day, it's just going to be a 125 to 200 stock. It's going to bounce, and that's going to be that. Okay, so that's my opinion on it. So as far as me and my Palantir shares here, I'm just holding, right? You guys obviously know I took the majority of my profits last year, and my plan is just to hold this 1,000 shares I have in the public account. I also have positions in at least one or two other portfolios, right? But I'm just holding Palantir as like, just in case it's that $500 opportunity. And I'm like, the growth rate's even more insane. And like, they keep accelerating it and like, they don't decelerate it, right? And they just go to 125% revenue growth and 300% revenue growth. I don't see that happening, but just in case, because the company is an amazing company, I'm holding that 1,000 shares there, right? But at the end of the day, my opinion is it's what I thought it was last year, and it's going to remain that for the next several years. So, but we'll see. Okay. Alrighty, next up here, let's talk about my ultimate 10 stock GVD portfolio. Then we'll get into 3 stocks that are ready for some insane moves and my expectations around those moves. Okay, number 1 of these 10 stocks. This has to be a core position in all individual stock portfolios, in my personal opinion, right? It is the big dog. Amazing Zon. Amazon has to be a core position in everybody's portfolio. It's a core position in all my portfolios. I don't know how it can't be. I mean, you're dealing with a company that, look at the AWS revenue growth. They're in a revenue growth acceleration phase, which is so exciting. We just went through that phase with Palantir. Unfortunately, that phase is over. With AWS, we still got that phase for at least another 1 to 2 years. At least another 1 to 2 years of revenue growth acceleration phase for AWS. Oh man, this is so exciting, right? And keep in mind, after the revenue growth acceleration phase is over, AWS, guess what it's going to be? A massive profit engine. And, companies talking about $1 trillion a year business. Boom. You have the e-commerce side of the business, which just gets bigger and bigger and bigger and bigger and will continue to, right? And much more profitable as years ticked on. And then really no competition in that market either, as far as direct competition in any serious way. And then the ads business continues to grow substantially. And that's a straight profit machine. We know the ads business is amazing, right? Great balance sheet, Andy Jassy leading the company, great team overall. And so Amazon remains a company you have to have as a core position. And so it's a big position for me in the public account, $441,000 in that portfolio. So, it's, around a 10% weighting there. And in some portfolios, it might even be bigger for me, okay? Number 2 stock you got to hold is And this one's another core, because you got to have 2 core positions in a portfolio, minimum, right? You either got to hold Meta or Google McDougal. Meta or Google McDougal. And so for me, I hold both, but Meta is a big position for me, right? In the public count, that's a little over, we can call it a 10% weighting of the portfolio, or significantly over, what am I talking about? No. Because this is $492,000. I'm up on the position, but then if you take it into account, it's significantly bigger than a 10% position in the portfolio overall, right? And then Google McDougal is a pretty small position for me overall. So Google McDougal, you got to hold one of those 2 stocks. You know, some people like Meta better. Some people like Google McDougal better. It depends, but you got to have those 2 as a core position, right? Amazon's a must, and then either Meta or Google, right? Number 3, I like this one a lot. SoFi. You're getting the big growth. You got to have that stock that just comes in and it's just like big dog numbers, big dog growth. That's SoFi. You know, latest revenue growth numbers are what? Somewhere around 40% roughly. It's insane. And so they've been putting up insane growth numbers. They likely should continue to. Obviously, when you go through recessions, these sorts of companies get hit. No doubt about that. But remember, this stock is still down 40+% from the highs it reached last year. So that's something to keep in mind here. But SoFi is one of those companies you're making a bet on a company to become a banking giant. And that's the trajectory this company's on. When you look at the numbers they come in with quarter after quarter after quarter, year after year after year, it becomes more evident that this company's on their way to become a financial giant. JP Morgan, Bank of America, Wells Fargo, one of those like banking giants. And like you look at where this company should head over the next 10, 20 years, like it's going to go there, right? And so Anthony Noto just has to keep the company clean in terms of not putting them in big financial risk for the recessions, get them through to the other side during those time periods. And oh my gosh, SoFi's got to be like a position in a portfolio, right? I keep it as a smaller size position. You're not going to see me have, you know, the sort of money I have in a Meta or a Google or in an Amazon as I would a SoFi, because it's a little more dangerous, but I'm still going to have it as a significant position. Number 4 of these 10, ServiceNow. I think ServiceNow is a great stock. It's a growth stock, right? But it's a growth stock with a value component in it. So I like some of these stocks that are kind of like combos of like, it might be a growth, it might be a dividend, it might be a growth, it might be a value, it might be a value, it might be a div, right? And ServiceNow, I think, is a good example of a growth and a value kind of meeting up. And so I really like that one overall as a business model and as a long-term opportunity. Next one up here, number 5 of these 10, this is Netflix. Netflix, this one is a good combination of growth and value. You know, Netflix forward P on the stock right now is probably about 20, somewhere around there, ballpark. It's way too low for a company like Netflix that is a double-digit a year grower and should continue to. Because remember, Netflix has 3 ways they grow this business. One is they always are attracting new subscribers, right? 2 is they can go up on their subscribers or different plans from time to time, right? And 3rd is advertising, right? That's really still a newer business for Netflix. They've really only started to build that over the last couple of years, but that's going to be very large business for the company over the next, 10, 15, 20 years. And so Netflix can continue to reinvest back in the business for more content, for if they want to get more into sports over time, which I think is something they will do because they'll understand, man, that's how you can really, bring your subscriber base up to even a higher level, as well as, we're really thinking about, and remember, if you're sports, I think there's going to be reasons for Netflix to acquire more sports over the next 5-10 years, right? Not over the next 5-10 months, but I think you're going to see more leagues want to be on Netflix because Netflix has the customers, right? And if your sports team, you're an NBA team, an NHL team, an MLB team, a NFL team, it doesn't matter what you are. You want to get in front of as many eyeballs as you can over time, and especially if you want to grow your base international, right? Because Netflix has a big international base as well. The more eyeballs, the more season tickets you can sell, the more rights you can sell, the more jerseys you can sell, all that sort of stuff. And so I think as a trend over the next 5-10 years, I think a lot of leagues and teams are going to be interested in having content on Netflix over time, right? And I see the way Netflix is positioning. I think they're kind of going with, let's call it not as popular things. And then I think they're going to get more to the popular stuff. as time goes on, right? And they're doing a lot of documentaries. You know, they got the Netflix shows, quarterback and receiver, and those sorts of shows, right? And so I just look at it and I'm like, the natural fit is there over the next 5-10 years, and that's going to be something that will be insane for their ads business over time. But I think Netflix really wants to get their ads business to a certain place before they really start bidding on these rights. And so anyways, Netflix, great long-term company. Number 6 of 10, it's a growth. It's Celsius. Celsius Beverage, I like this one a lot. Only up $12,000 on this. I think, you know, when we look at the stock a year from now, 2 years from now, 3 years from now, I think it's going to be a lot higher than here, right? But this is a company that's got great growth, a drink-related company, not a business model that you just like disrupt overnight or something like that, right? And of course, there's always energy drinks trying to launch here and there, but at the end of the day, like, there ends up only being a few players. Like, I started working at Walgreens in 2008, right? Back then, there was a lot of different energy drink brands, and you know, most of those brands you wouldn't even know about today. Like, I remember there was Full Throttle, right? Like, that was a brand. Then there was obviously Monster, there was Red Bull, there was Rockstar. You know, Rockstar is hardly relevant today, right? And that was like a big brand back then. And when I started at Quick Trip in 2010, that was like a big brand. They were like really selling all at the end of the day. It was just Red Bull and Monster over the years, right? And there was all these other random brands. I remember, you know, back in the energy drink days, like local brands in Phoenix back then. And it's just like, you know, at the end of the day, it ended up being 2 companies. And so nowadays it's 3 companies because you got Celsius, which owns Celsius and Alani. And now they just acquired from Pepsi Rockstar, which they ran into the ground, right? And so I really like that company. I think you got a 3-horse race long term. When I say long term, over the next decade. And energy drinks, and I think, you know, 3 companies fight hard for it. And I think Celsius is going to be the biggest winner of the bunch, in my opinion. Their brands are really positioned well in the marketplace. And so Celsius. So number 6 of 10. I think it's a great growth stock to have in there. Number 7 of 10. This is a value and dividend play here. It's Estee Lauder. EL Estee Lauder, up $27,000 in the stock so far. Got a long way to run in this one. And Estee Lauder, they own some of the best cosmetics, beauty brands in the world. And those brands, you know, they've been around for decades and decades and decades. And it's just about selling to the new generations, right? And they're higher dollar amount brands, so they're not as much about pushing volume. Like, let's say an Elf. Elf's all about volume, right? Estee Lauder, EL, they're really about, you know, making money on those products and having great margins on them overall. So EL, really like that one overall as a value dividend play. Next one up here, number 8 of 10. It's Cheesecake Factory. This is one of the best stocks in the market. It is one of the best stocks in the market. And I don't just mean like on a performance basis, like it's been amazing over the past 3 years. But, you know, when you really think about Cheesecake, the thing that makes it magical is you're getting a value and dividend stock, right? They pay dividends. They trade it, in my opinion, pretty cheap valuation on a forward P basis, 2-year forward P basis. But you also look at the company, you're like, I can see how this company grows for the next 10 plus years, right? They can always attract more customers. They can always do more off-premise sales. As far as the brands, they're as relevant today as they've ever been, if not more relevant, right? They always can go up on price a couple percent a year to keep up with inflation. So that always gives you a few percentage of revenue growth there. Then additionally, Flower Child has at least 10 plus years of growth ahead in regards to just getting locations out there. And those locations, comp store sales are going insane. That was up to 13% the most recent quarter, right? And then North Italia, that's got another 10-year runway there. Plus they got a bunch of brands coming behind that. I'm like, you've got growth for the next 10, 15, 20 years, but it trades at not the valuations you would think for a growth company, right? Which usually those companies trade at, 70, 80, 90, 100 P ratios, but Cheesecake Factory, since they don't have the raw number of the big growth, people don't look at it as a growth stock, but it should be viewed as a growth stock because you've got an easy way of growing this company over the next 10. Obviously they got to execute, but it's like not a confusing vision to see. It's like, build more Flower Child locations and put up great numbers. It's not complicated. It's like Chipotle back in the day. Execute your business model and build more locations. That's a restaurant game. And so when you got a banger concept, which Flower Child's a banger concept, they got a winner chicken dinner. Same thing with North Italia, but Flower Child's the biggest opportunity. Flower Child has an opportunity to be bigger and more successful and make the company more money than the Cheesecake Factory. And that could happen in the next 10 years. And that would be pretty amazing, right? Because Cheesecake Factory is one of the most successful, if not the most successful restaurant concept, you've really seen over the past couple decades. Number 9 of 10, This is mega growth. AMD. AMD. Listen, the stock's up a lot since I started buying it, right? We're up $953,000 on AMD. But my opinion is this stock moves to the $1,000 to $2,000 range, right? If things go really great for AMD over the next few years, we're going 2,000. If things go not as great, I think we're headed to 1,000 and maybe 1,200 over the next, few years here. And there's a potential this stock goes 1,000 plus in the next 12 months. That's what people don't understand, right? Because these semiconductor stocks, when they move insane. Okay, and so AMD, you gotta own a semiconductor company in the portfolio. So it's like, who do you want to own? Do you want to own Nvidia? Nvidia's got great numbers, but Nvidia's got a low valuation as well. But they've got margin risk and they've got market share risk over the next few years because of this company you're looking at in front of you right now. Okay, so it's like, okay, you could own Nvidia. Then you could say I could own one of the memory chip companies. You could, but the problem with those companies is they always trade at crap valuations. They always will trade at crap valuations. And then there's AMD. And it's like, okay, I think I'll own AMD, right? So that's mega growth. And then number 10, you kind of always got to have a spec in a portfolio. Like something that gets you going. Cheap stock, under $5 club, right? Something in the gulag. And that's honest, for me at least, right? That one, I look at it as like that cheap stock. But the thing that I really like about honest is it's not a spec in terms of the normal spec stocks you usually have. Because usual spec stocks are like horrible balance sheet, like losing a ton of money, might go bankrupt. Like Honest should make, my guess is tens of millions of dollars of net income over the next year with having a great balance sheet and improving margins that are really starting to, trend significantly higher. I think Honest is a great spec stock. And I think that one exits this year at $5 plus. And likely long term, it's a $10 to $20 stock, which is significant upside from a $3 stock as it is right now, right? So, if we're going to play on the spectrum, I like to play on the safer side, right? And I feel like Honest is that, right? No, I always get one of these comments whenever I do one of these, one of my favorite stocks to say, but Jeremy, there's no stocks you don't own on that list. But here's the deal. You know why? Because if there was really great stocks that I thought were huge money makers over the next few years, guess what? I would own them. It's as simple as that. Like the stocks I believe in the most, I'm going to own them. That's how it works. And so, if there was some magical stock that I'm like, oh my gosh, this stock, I think it can go up 400% over the next 4 years. Guess what? I'm going to own the flipping flapjack in stock. It's as simple as that. So I'm not just going to make a list and throw in stocks that are stocks I don't believe in just because I'm like, oh, I want to throw something in because it's different than what I own. For what? Oh, I'll throw Apple in the list. For what? I don't think Apple's gives you a great ROI over the next 3 to 5 years. Like, okay. Like, well, why would I throw it in the list? Like, just because I don't own it? So, anyways. All right, next one up here. 3 stocks that are ready to move huge. And what are my expectations here? Okay. Listen. Number 1. AMD. AMD, their quarter's about to come out, right? Now, expectations for this quarter, $11.3 billion. Don't be surprised if they beat that, easily. But the next quarter, analysts are at $12.5 billion. I don't see how AMD doesn't do $15 billion plus next quarter. I don't see how they don't do $15 billion plus. The highest analyst estimates out there seem to be like 14 billion. And I'm looking and I'm like, I think even the highest number is low. I think they'll end up doing $15 billion plus. I don't think anybody's ready for flapjacks, right? The following quarter, analysts have that at 15.6. I don't see any way they don't do over $18 billion that following quarter. And the following quarter, analysts are at 16.8. I don't see how they aren't over 20 billion by that quarter. And the following quarter, analysts are at 18.5. I don't see how they aren't over $25 billion for that quarter. So I'm looking at AMD and I'm like, dude, I think the analysts are way off sides here. They've totally misunderstood AMD this whole time. We have to acknowledge that. Have they not? Of course they have. Their price targets were all wrong. Their projections were all wrong. Their understanding of the business model and what Lisa Su was up to was all wrong. They were all wrong. And now, we're starting to see the truth. The truth is coming out week by week, month by month, right? And year by year. And so I think they're wrong again. With these analyst estimates, I'm looking at them like they're way too low, they're way too low, they're way too low. Like, it's not like it's a small amount either. If it would be one thing if I was like, analysts are at $12.5 billion and Lisa Su's going to say, we're going to do $12.9 billion next quarter, right? I'd be like, dang, man, I would be super disappointed by that. But I look at that next quarter and I'm like, I don't see how they don't do $15 billion plus. Because you got the GPUs really hitting, right? And then you got the CPU demand really hitting. And then every single one of these quarters from here on out is like, the analysts are way too low in my opinion. And then you have to adjust all your 2027 numbers, right? So, baby, right? And so there's a reason keep talking about, I think AMD is going 600 plus this week. I truly do. And maybe it doesn't happen, right? And so is my AMD investment over if it doesn't go $600 plus this week? Of course not. It's been amazing for me. It will continue to be amazing for me over the next few years. But when I look at it, I think we're going to get shock and awe for the next several quarters for AMD. At least the next 2, if not the next 3 quarters, I think we're going to shock and awe guidances. And people have no clue what's coming here. And they're going to be like, oh my gosh, like AMD's doing way better than we thought it was, right? And when that reality hits, Wall Street's going to look at the stock as the hottest stock in the market that you got to be part of. The memory trade is, it still can go a leg higher or 2 from here. So I don't want to say the memory trade's done, but it's played out, right? Like no one's excited about the memory trade play. It's just like, oh, there might be more money to be made there, but it's not like that's the exciting one. That was the super exciting play, right? Prior to that, it was Palantir. Prior to that, it was NVIDIA. AMD's next. And AMD's obviously already started the move, but it hasn't really got that everybody in the stock market's talking about it. I think we're about to have that moment over this next 6 to 9 months where it's going to seem like everybody's talking about AMD. Like top of CNBC shows are going to be talking about AMD, 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 AMD. You're not going to be able to hear enough of it, okay? So that's the first one up here. Next, this one is Celsius Holdings. Celsius Holdings, they report earnings this week. Listen, I don't have a strong opinion on this quarter's numbers or next quarter's numbers, but I think analysts are way off again. And this one's in regards to their understanding of long-term growth rates for Celsius. Analysts have them at single-digit growth. Basically, they have them at double-digit growth for these next 2 quarters, and then after that, single-digit from there on out. And like, I don't think they studied Monster. Monster was, I used to own that back in the day when it's Hanson's Natural Beverage, right? And I don't think they understand when you have multiple brands like Celsius does, right? You got the Celsius brand, you got the Alani brand, and then Rockstar, if they can revive that, we'll see what happens with that, right? I'm not going to get my hopes up there. But you always have a few different plays. One is going up on price a little bit over time, right? 2 is selling more volume for one brand, and the other is selling more volume for multiple brands, right? And then the other, you have another growth lever here, which is getting into more locations in the US. There's always more shelf space to gather, right? And there's always more locations to get into. And the last one is, and this one is not tapped by Celsius that much. Still significant, it's still a very small percentage of the company's overall revenue, and you know what that is? International. So as Celsius gets bigger international, and then Alani gets bigger international, that's another lever of growth that I don't think analysts are taking nearly serious enough. So I look at Celsius as a company that should be able to grow double digits a year. It's just a question of like, is it 12%, 15%, 20%, or 25% a year? For years to go in the future, like put us all the way into the 2030s. So I think analysts are way off there, and I think they're going to have to come to a conclusion over time, right? So my view is Celsius is a $50 plus stock next summer. And long term, this is a $100 plus stock, in my personal opinion. So the stock in the 20s, you know, my opinion is any shares they sell me in the 20s, I just have to say thank you. Thank you. Thank you for selling me Celsius in the 20s. I very much appreciate you, okay? Next one up here. This one also reports earnings this week, and it is Elf on a Shelf, okay? Now, there's another one. I don't have super strong opinion on this quarter's revenue number or next quarter's, but I know analysts are screwing up bad here, okay? I'm looking at these analyst projections here, 5% revenue growth, 3 quarters out, and then 6%, 8%. I'm like, oh my gosh, what are you guys doing? Elf, okay, so Elf. One, shelf space expansion, right? Like this is a company that undersells in almost every retailer. They way oversell for what their shelf space allocation is, right? Additionally, price. They can always go up a little bit here and there on price, right? Additionally, international expansion, again, right? Additionally, more locations. There's always another retailer to grab out there, right? Additionally, new products. They're always launching new innovative products that, you know, become the next big thing. Next up, Rhode. Rhode is arguably the hottest brand in cosmetics right now. and that's Hailey Bieber's company that they acquired from her. I mean, that one should continue to have a great growth trajectory for the next several years. And then they own other brands as well, and then international expansion of those brands. So, I mean, Elf, I just think they're way off in regards to this one. There's another one I look at that is an easy double-digit a year grower put us into the 2030s. And so I think there's going to be that realization that comes about. Now, in regards to Elf on a Shelf, here's the other thing, right? This stock has this weird thing where it'll go really low in the late winter time into the springtime, and then it goes on a ripper rally, through the summer to about January. And we're in that run already. The stock bottomed a few months ago. The stock bottomed actually not even a few months. Yeah, it was a few months ago now, a couple months ago. It bottomed back June. So it was right about 2 months ago, right around this time, right? Early June, I think it was June 5th. Stock bottoms in the 40s. And since then, it's up to 82. My opinion is the end of this year, it exits this year somewhere between $100 and $140 a share. And so it's on its run now at this point in time, right? Now, there's a lot going on. There's going to be a lot of earnings coming out. Make sure you guys are checking for my reaction channel as well. This week, Jeremy Lefebvre Makes Money. And I know a lot of you guys are subscribed over there as well, and you watch all the videos that I release on that channel as well. But keep in mind, like AMD earnings, I might cover them on this channel rather than on the main channel. Elf, I might cover on the reaction channel, and same thing with Celsius, right? And so just be aware that channel might come in key this week, okay? I hope you guys really enjoyed today's video. I appreciate it. I'm happy to be back from that cruise experience. And once again, in the description area down there, if you look to apply to join my private group, you want access to all my course curriculums, access to my private Discord chat, exclusive weekly videos, all that good stuff. You're going to apply to join my private group, as well as access to 1000xstocks.com. If you want to join my Patreon, see the moves I'm making each week in the Patreon portfolio, you can subscribe there. If you want to follow me on Instagram, that's there. My X page is linked there. I post a lot of stuff on X. And then also, if you want some free workshops, I got them there. Alrighty, enjoy, much love, and have a great day.